Mag 7 hasn't been the monolith that it had been the last couple of years.
Tech companies have healthy balance sheets, but on the margin, they're getting worse rather than better.
More cash flows generated in Mag 7 than the rest of the S&P.
There is a lot going on into next year, which is why I think we're positive, but I think there may be some volatility.
There's a 30% chance that you get a full-on bubble next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance on this Friday. Stocks poised for their third straight week of gains, climbing to all-time highs yesterday as hopes for that Santa rally take hold. Investors looking beyond just big tech as they see Fed rate cuts helping to fuel broader economic strength. Now the focus turns to next week, a dump of much-awaited data with the November payrolls report, retail sales, and CPI on deck. David Gura pulled the short straw once again. I'm so glad to have you in the seat. And David, to me, this is going to be a real question. How much does the economy rise to the occasion of the strength implied by some of the recent equity gains?
Yeah, we're on the heels of this Federal Reserve meeting where the Fed chair was very forthright about the fact that he didn't have the data that he wanted to have going into this. He's kind of fumbling through this in the way that he can, only because we have all this backlog of data. We haven't even known when it's going to be released. So this is a pivotal moment, I think, to get confirmation of the very rosy growth forecast that we got at that meeting just a couple of days ago.
And whether we can see the sustained rotation.
Yes.
We're seeing it, again this morning, this idea that even if you have big tech underperforming and you have some of the biggest names in the index declining significantly, you still can eke out gains, highlights how much people are turning their eyes elsewhere and how much people can look past the pain of potentially overestimating some of the gains from artificial intelligence.
There we go. So we move from Oracle to Broadcom. Less agita surrounding those earnings releases, I think, although funny that the company performed very well by many measures. And yet there is this open question of what's the timing? We talked a lot about that yesterday. When does Wall Street need to see the proof in the pudding? He was unable to answer that, even though, again, sales figures, revenue, all rosier than I think a lot of people expected.
And I think ongoing, the question is going to be, are some of these tech companies not delivering on very high expectations, or is this an issue of investors looking for any excuse to sell and potentially some bright shoots for people who want to get bullish in the sector? Because guess what? This is not a full-blown bubble if everyone is so skeptical and keeps on talking about bubbles.
There you go. And we did talk a lot about bubbles, made the hand motions yesterday over again. But yeah, I think consensus is we're not there yet, but there are some signs here that are worrisome for a lot of folks.
Right now, what we're seeing in markets is just taking a little bit of heft out of the rally that we saw yesterday, closing at all-time highs, dipping just about 0.1% on the S&P. You're seeing a little bit of yields rising on the long end, the rally into the front end continuing, yield curve steepening, getting to the widest in the 2-10 spread going back to April around the Liberation Day discussion. And, after seeing some dollar weakness and the expectation that next year you could see ongoing dollar depreciation, right now just around that 117 mark on the euro dollar. Coming up this hour, Peter Shear of Academy Securities with stocks trying to end the week at fresh record highs. Jason Bazinet of Citi as Disney makes a $1 billion investment in OpenAI, and Karen Mana of Federated Hermes with historic AI deals reshaping the debt market. So begin this hour with stocks steady as the focus shifts from the Fed to the data. Peter Shear of Academy Securities writing, now we can watch the data and let the countdown to the Santa rally begin. And you put a little smiley emoji, and there's a real question here. Is this ultimately a market that wants to go up and is going to go up because there is a dearth of other information to really prevent it from doing otherwise?
Yeah, and I think you're seeing it, the Russell 2000 is doing very well. I think there's still questions surrounding, the big tech, the AI story, but you're seeing the equal weight S&P 500 do better, Russell 2000. I think it's helpful that the Fed is buying some T-bills up to $40 billion a month. So you're seeing all that. I think, the Oracle earnings yesterday kind of spooked the market a little bit. And I think that's maybe the one susceptibility is there's a lot more questions around the AI data center, but if rates are coming down, I think we're going to get rate cuts faster than market's pricing. That should be really good for small caps and the broad economy.
How much better are you feeling about big tech, given the fact that you've seen such a lack of enthusiasm following some of these earnings?
I think there's still questions about valuations there. The one thing that's, I think, coming up in every conversation we have is more and more questions about the electricity bottleneck. How are we going to run some of these things if we can't produce the electricity? So I think, again, we're going to see a lot of investment into electricity next year. That's going to be a story. I still think that come the next election, electricity and electricity costs are going to be an election issue.
Peter, how much do you look at a company like Broadcom or Oracle as a proxy for this nascent industry as a whole?
There's kind of that collection. You're looking at what they're doing. You're also trying to figure out how, again, the Disney announcement yesterday, how are stocks reacting to this? And, it feels that we've kind of gone through this period where if you raise your hand, say anything AI, your stock shoots higher. Now there's a lot of questions. People are trying to figure out where's this going to work? How's it actually going to work? And, again, going to be somewhat facetious. If you spend $50 million and you hire 10 fewer people, how much were you paying those people? Maybe you shouldn't have done that. So I think the AI story is growing and we're seeing the use, but now it's kind of, there's a little bit more question. Are you spending it? Are you getting value? How do you want to use it going forward?
Lisa mentioned the high expectations that we've had for a lot of these companies. Is this a moment to recalibrate or rethink what those expectations are? So I look at a company like Oracle, I look at a company like Broadcom. There's been a lot of happy talk. It has performed very well quarter after quarter after quarter. Now we're at a point where maybe we just can't reach those expectations that have been in place for so long.
Right, it gets much more difficult. So again, one of the trades we've liked is you are either underweight QQQ or the NASDAQ 100, and you're overweight either the S&P 500 equal weight or the Russell 2000. I think that's where the performance is going to come as we realize all these other companies who are benefiting from AI, they should trade maybe at better multiples. The business is here, and you're starting to see rates come down again, which helps a lot of those companies much more than it helps, I think, the big companies.
We're kind of walking a tightrope, though. I remember just a couple of months ago, people saying that if the AI trade doesn't work, it's going to bring down everything, because ultimately the entire market and economy has been propped up by AI hopes and dreams. Why has that changed in terms of a narrative so substantially?
Well, I think we're still seeing the investing going on in that part. So the spend is still there. So I think if that spend really drops, that's where you start really getting into trouble. Then we start questioning, okay, where's this economy head? And I'm definitely not quite sanguine about the economy. I think there are some risks there. I think the jobs data, I think a lot of companies are actually going to budget less spending next year. I think it's going to start flowing through the economy where you slowly see the uptick in tariffs, right? As this tariff revenue keeps coming in slowly but surely, 240, 250, 300 billion, that's when you start feeling the impact on that. I think the job market's a little bit sketchy. What I did, of all the data I saw this week, I still look at the JOLTS quit very, very closely. To me, that's the closest we get to crowdsourcing. We're back to levels in the quits rate, I think it was 1.8 or something. It goes back to 2015. People aren't comfortable leaving their jobs. That tells you everyone knows the job market's a little bit sketchier than maybe the data shows.
I'm so glad you went there. Next week, we get the November jobs report, which, of course, is delayed. And a lot of people, Anne-Marie in particular, was really annoyed that we didn't get it before the Fed meeting. And we seem to get indication from Fed Chair Jay Powell that there is this weakness in the labor market that you're talking about. How pivotal is that report to highlight that things aren't falling off a cliff? Mm-hmm. Yes, the Fed's going to cut rates, but the economy is actually still hanging in there.
Well, I hope it's pivotal and shows that we're not falling off the cliff. I think there is a risk that this data comes in much weaker than we're expecting, and it's kind of this wake-up call. Okay, we've all been talking about this jobless recovery, and yeah, the data center spend's been driving a lot of the economy. Where are the jobs? Who's getting the jobs? Where are they coming? Again, everything I talk to, and probably near and dear to my heart, kids graduating college, the job market looks very bleak right there compared to what it's been a few years ago. So I think we might be starting to get the data that really starts confirming, whoa, something's not quite working. And I think everything's been a little bit tolerant. Let's see how these things play out. Let's see how the trade deals play out. Let's see. Now we're at that proof is in the pudding. And I'm a little bit nervous that the jobs data is going to show this is not working the way we hoped it would be.
How are you thinking about Fed timing and insurance? I think Claire Jones of the FT asked a question a lot of us had going into that meeting, which is, why do this cut now? Why not wait till January when we would have the data that we're talking around, because we haven't had? Why not wait into January? Did he give you a satisfactory answer to that in that press conference?
I think the ultimate reason is they are concerned about jobs, and there's just enough out there, I think, on the jobs data, and not just official data. I think it's anecdotally, right? There's no one I'm hearing talking about, oh, there's some great underlying strength, and, it was kind of weird. They did raise the GDP forecast, but again, they didn't seem to, accompany that with a big job growth. So I think that's why they did it, and honestly, I think you're going to see a lot of pressure. I think the market is going to get to 3% on Fed funds way faster. I think we get there by the summer, and the market's not pricing in 2 cuts next year until September. I think Powell will have to cave. I think we're going to have to move, and this is going to be an aggressive cycle where we've been maybe a little bit tight too long, too dependent on allowing that AI spend to maybe cloud or cover up that there's an underlying weaker economy going on.
Curious if you noticed something that I did during that press conference, which was the Fed chair very willing to engage with AI in a way that he hadn't been able to before. So there were a number of colloquies with Howard Schneider and Neil Irwin, Steve Leisman. They asked about AI, how much he's thinking about it. And he was pretty optimistic. He talked about the prospects of AI spend continuing here at a moment when we are, candidly, kind of wondering about how long that's likely to persist. What did you make of that, his kind of recognition of the fact that this is going to be rather seismic going forward?
I think it's good. I think it all makes sense. Again, I we are going to continue to use AI. People are going to refine how they use AI. They're going
He admitted he uses it, which I thought was interesting.
I think, I've used it multiple different ways. If I'm on Twitter, I tend to use Grok. If I'm on my desktop, I tend to use ChatGPT or something like that. So I think it's an important part. But again, I think we also see some of the limitations. And I'm still at this concern that we're basically paying 2030 prices for 2025 technology. And so it's not quite where we want it to be. And people are going to be a little bit more thoughtful on their spend. And I keep coming back to whether it's with the DATs or the digital asset treasury companies, when there's this, you raise your hand, you raise free money, it's going to continue. As soon as you start really questioning, are we getting the value? And what are the limitations? Again, I keep thinking that it's going to be electricity and power generation is the limitation. People are going to have to think twice. That's where it's going to stall out a little bit.
David, I'm so glad that Peter talked about this, the idea of are we getting the value? I think about ChatGPT. I look up medical problems. With Grok, I say, is this real? And that's what everybody does. Is this real?
Your doctor is thrilled that you're doing this.
So it's sort of at a certain point, you could either go to the Merck manual or you could actually just not have digital manufacturing of concepts, and then all of a sudden you clarify those two issues. I mean, are we actually solving some of the issues that people think will create the productivity boom that's being priced into the market?
I've heard skeptics say you can take out a calculator and do 2 + 2 is 4. If you do it through ChatGPT, it's going to take I don't know how much more energy to do that than it would with my little solar-powered calculator. But this is a real issue. I think people are I think it's emblematic of the fact that we're trying to fumble through this, figuring out sort of what the best use case is. We're doing that individually, you with your medical interests or whatever, and but just
Why do I have a pain in
more
my
broadly.
shoulder?
But then there's this whole enterprise facet of this as well, which is I think companies are still embracing this largely, but in a kind of blind way, not knowing how it's going to be applicable to what they're doing.
Yeah, and I again half jokingly say I think in some cases if they just asked their employees who've been there 3 or 4 years what they should do, they'd probably get a really good answer. Maybe we should go back to empowering our employees too. Like people know the situation, and some of this feels a little bit like a crutch. And again, there's going to be useful parts of it. I think the limitation is how much data you have, how useful is your data. You got to plug it into there. So people are using it. I think it's makes people slightly more productive. I don't think it's kind of this be all and end all that ultimately it should get to. Right? It's going to do more and more. It's going to get better and better. I just don't see the technology quite at that level. And when I try and use it, it's great until you realize, oh, it hallucinated a ticker symbol. And now I'm like, now what else do I have to check? What else do I really need to go? And also, it's how do you learn if you kind of rely on it for too much? So.
Yeah, I will say, my kids say, look, I don't know how good it is if it didn't get me an A on the paper. Just saying. Peter Scheer of Academy Securities is going to be sticking with us for the hour. We're going to get into geopolitics and a whole host of other stories coming up. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, good morning. China is investing in its homegrown chip business, preparing as much as $70 billion in chip sector incentives. The program aiming to reduce China's reliance on foreign chip makers and support local companies such as Huawei and Cambricon Technologies. President Trump signing an executive order to go after state-level regulation of artificial intelligence. Trump saying the industry shouldn't have to navigate a patchwork of AI rules. The order directs the Attorney General to set up an AI litigation task force to sue over state laws that are inconsistent with the White House policy. Lululemon shares rallying in the pre-market. The company announcing that CEO Calvin McDonald is stepping down at the end of January as the company works to reignite growth. The CFO and Chief Commercial Officer will serve as interim co-CEOs while the company searches for a replacement. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, pushing for peace.
To make elections possible, there must be a security component, and America can help with this the most.
We would help with security because it's, I think, a necessary factor in getting it done.
Bloomberg's Tyler Kendall and Oliver Cook both joining us next to get the latest. This is Bloomberg Surveillance. Looking at trying to get another day of gains after what we've seen for the past week, which is potentially a third straight weekly gain. Yesterday, we saw all-time highs. Today, taking heat out of that, S&P futures lower by 0.1%. The underperformance at NASDAQ in the tech-focused sectors down 0.5%. Check out the Russell 2000. This has been the outperformer. It continues to be today. This has been the rotation up 0.4%, absolutely surging with a whole host of contributors as you have a yield curve steepening, as you have this optimism about Fed rate cuts, and frankly, as people look to more underpriced sectors within the broader equity space. Right now, if you take a look at 2s, 10s, and 30s, that is where you're getting the yield curve steepening. That is where you're getting the action that's driving some of the heat in particularly bank stocks, but in the broader sort of rest of the market. 2-year yields lower, just a touch, 3.53%, but higher across the board. 30-year yields back up to 4.82%. You're seeing the steepest 2s, 10s gap going back to mid-April. Under surveillance this morning, pushing for peace.
We can try to hold elections. Ukraine is not hiding from democracy, but to make elections possible, there must be a security component, and America can help with this the most.
We would help with security because it's, I think, a necessary factor in getting it done. We'll be attending the meeting on Saturday in Europe if we think there's a good chance, and we don't want to waste a lot of time.
Here's the latest. Ukrainian President Volodymyr Zelensky floating the prospect of conceding territory to Russia. President Trump mentioning U.S. security guarantees without specifying details. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington and Oliver Crook in Brussels. Ollie, I want to start with you. What do you expect from these meetings? Where is this lining up in terms of where Europe is and what Ukraine is expecting from the United States?
So what we understand is the last draft that was sort of edited by the Europeans and the Ukrainians is still resting with the United States for their evaluation. They, of course, will give an opinion on that. And then there is this meeting over the weekend at the high level of Europeans. And as you heard there from President Trump, still evaluating whether or not the American delegation will participate in those talks. As we know, the Trump administration has been fairly impatient about the speed at which the Europeans are moving, saying he doesn't want to attend talks just for the sake of talking, meetings just for the sake of meetings. But I do think it's significant that President Trump is talking openly about security guarantees, obviously a fundamental part of these negotiations, but not something that President Trump tends to talk that openly about, though he did not detail what they would actually include. I would say that the most interesting thing, though, that we've seen over the last 48 hours or so is this sort of geopolitical judo that Zelensky is playing, using the momentum of ideas that are quite hostile towards Ukraine from the United States, holding elections, also this idea of conceding territory and saying, listen, we're willing to do these things. We will say there are no bad ideas coming out of Washington, D.C., but if we hold elections, we need security guarantees. We will hold them in 60 to 90 days if you can guarantee the conditions for security for holding that election. So Zelensky, in that way, providing what the United States would like to see, but getting something in return. And the same thing with this idea of a referendum over territory. This is obviously the most contentious part of this peace proposal, surrendering additional territory to the Russians. If Zelensky can say, hey, listen, we're bringing this to the vote, to the population, one of the most emotional issues that we can possibly think of, and it's the Ukrainian population that will decide. A, it takes out all the wind from the sails of those who call him a dictator and say this is non-democratic. And B, it shows in very sharp contrast what a democracy looks like versus Russia.
As Volodymyr Zelensky plays diplomatic jiu-jitsu, Tyler, there is this question in the United States where President Trump sits on this. He said mixed messages. On one hand, expressing a lot of frustration with how long this process is taking, trying to get this done by Thanksgiving. It went past that deadline. On the other hand, he talked about potentially providing security guarantees. Do we have any insight into which way he's leaning?
Right, Lisa. I mean, at this point, it's always been shifting, as you're outlining here. But of course, as Oliver just outlined, security guarantees have long been one of those key sticking points. And we really have seen the White House's position on this evolve. You'll recall for months we heard from U.S. officials that the guarantees were really only going to be implicit guarantees because the U.S. would have a vested economic interest in the future of Ukraine after inking that critical minerals deal earlier this week. In the months since, though, it has shifted with the U.S. committing to air support and intelligence sharing. But we know that Ukraine really wants to see the U.S. go further, perhaps even something that mirrors NATO's Article 5 mutual defense clause. But again, it is unclear at this point exactly what the U.S. will commit to because there has been this mounting frustration. Now, as Oliver also mentioned, it's unclear right now if the U.S. is going to send a delegation to those talks over the weekend, despite urging from European allies that President Trump himself should be there. But we should mention that the Ukrainian President Zelensky did have a meeting with some high-ranking U.S. officials earlier this week, including Secretary of State Marco Rubio and Special Envoy Steve Witkoff. And in the wake of that meeting, the U.S. has been really pressing our European allies to press Ukraine to accept the peace proposal that the U.S. has put on the table. Because, Lisa, you mentioned shifting deadlines. Ukrainian President Zelensky said yesterday it was, of course, no longer Thanksgiving. We're past that, but that the U.S. has made absolutely clear it wants a clearer picture on what Ukraine will accept by now Christmas Day.
Ollie, one thing I'm wondering about, are you hearing anything about Europe's plan for Russia's frozen reserves? I think there's been some pressure on them to try and seize that. That could be a potential shift in the talks. Are you hearing anything, how they're leaning towards on that?
Yeah, so I'm standing right now at the European Council where European finance ministers are entering their second day of meetings, and this is one of the big issues they've been grilled about for the last couple of days, and I spoke with a couple of finance ministers yesterday on this very subject. So we should say there are two main hurdles. One is the question that to freeze these assets, you need to roll them over every 6 months. That takes unanimity of every single European state to vote on. The Europeans are now changing that rule so that they can go by a so-called qualified majority, meaning they can ice out Hungary and Slovakia, who have been these sort of people who go against the consensus in Europe, in order to freeze those assets indefinitely. That is one of the key steps to getting those assets to the Ukrainians. The second step is the question of Belgium. They want to have financial guarantees. Most of that money is held in Belgium. They don't want to be on the hook if they get sued by Russia or this war ends for 140 billion euros. The first hurdle has been cleared. Now the second hurdle is what they're trying to deal with. We have not yet heard guarantees from the Belgians to say that they're comfortable with the reinsurances that they've got. That being said, we are starting to get from European leaders a lot more optimism that they'll be able to come to a deal on this next week when European leaders meet in this very building. I should just say that this is, I have to say, the last point of leverage that European leaders can really bring to the negotiating table in the last moments of these peace talks. A failure to do so would be yet another humiliation, I think, for European leaders in a year that has been fairly rich in humiliations and geopolitics for the Europeans.
Oliver Crook, Tyler Kendall, both of you, thank you so much for your reporting. Peter Scheer, you just asked this question about the reserves. This has been one of the points of leverage. This has also been one of these sort of Hail Mary approaches for Europe to get some funding into Ukraine. From a market's perspective, why is this so crucial, right? What are the implications here?
I think if they don't do this, Zelensky's going to get forced into a peace deal with Russia, not on good terms. I think Europe's going to lose out on a lot of this. So I think this is really the only lever that Europe can pull. To get this money, it might switch the narrative with President Trump, too, where they go, hey, we can actually now afford to buy better equipment from you, more equipment. Will you sell it to us? And I think it's the only way to put any pressure back on Putin. And it's the first time I think they're coming close to doing anything. Again, Europe cannot do enough militarily. They don't have the military to support Ukraine in the right way. That's the only step they could do. And it's the only thing that I think puts any pressure on Putin to come to the table in better terms than he's currently willing to do.
Oliver mentioning a moment ago the specter of Russia perhaps suing Euroclear. That happening according to Bloomberg News this morning, just a few hours ago. That suit being filed by Russia. Peter, I'm curious, as you watch all this unfold, your sense of the U.S. strategy here. So we have the president kind of going with that this could be an email strategy toward these meetings. He'll show up if there's something tangible that could be gained from them. But, you know, we've seen this evolution, the kind of diminution of this 28-point plan down to a 20-point plan. Your sense of sort of who is running point here and what the U.S.'s goals are here going forward as these talks unfold?
You know, I think the U.S. wants to give a lot of preference to U.S. corporations in the rebuilding of it.
It's business-based.
They want peace. Yeah. And if you look at the original 28-point plan, right, Russia was going to contribute a bunch of those reserves to projects that the U.S. would get 50% of. The one thing I do know from people in this administration, the president was very frustrated with the rebuilding of Iraq, where he felt the U.S. companies weren't given enough of a head start to really benefit from this. So if we get some sort of deal and it's driven by the U.S., look for U.S. companies to have a really good head start in the rebuilding of Russia and Ukraine, 2 to 5 years, I think. And when we're looking at that, we think something's coming through. The only lever of power that Europe can pull is this reserves. We are going to see this rebuilding in places I think that are going to become really interesting. Poland, which has already become a hub. Mm-hmm. And we're also hearing more and more companies are going to base themselves in Romania. Romania has actually done a very good job where the borders are. It will allow companies to operate in both Russia and Ukraine as part of this rebuilding, but on safer territory. So I think that's where this is all headed. It is somewhat transactional, and it's really, I think, in Europe's hand to either get these reserves, change the narrative, or it's going to get pushed into some sort of peace deal so we can do the business.
In Europe's hands, but a very funny phenomenon here is we see that gulf between Brussels and Washington, Europe, and the United States growing wider and wider. Just curious to me, Lisa, as I watch all of this unfold, sort of where this lies in the broader strategy. We see the national security strategy. Europe being very much alone from the U.S. in so many ways right now.
Yeah, and how much some of the geopolitical alliances are shifting and where Europe ends up in some of these, which is the reason why they're grasping at the last straw of leverage that they potentially could have. Right now, we're looking at markets churning as we see all of this. Peter Scheer of Academy Securities will be sticking with us. Coming up, we've got Jason Bazinet of Citi as Disney takes a $1 billion stake in OpenAI. It is deal season. It is mergers and tie-ups and all sorts of strange alliances. Plus, Yahaira Anand with your morning movers. Shares of Lulu higher after announcing a CEO shakeup. What kind of feeling is it when you leave as a CEO and the shares are up 9.5%? This is Bloomberg. Taking a little heat out of the rally that we saw, get stocks to record highs to close yesterday. Right now, just off about 0.1% on the S&P. The underperformance continues to be in the big tech space, with NASDAQ lower by almost 0.6%. The outperformance once again in the small caps. Russell 2000 futures up 0.3%. The Y is very much in the bond space, very much on the heels of the Fed meeting where there was a rate cut, the third consecutive one, in addition to expectations for additional ones next year and in 2027. The front end lower, 3.53%. The long end higher. 10-year yields 4.17%. 30-year yields back up to 4.82%, leading to this yield curve steepening. And I do want to point to silver. Silver has actually been on a complete tear, has gone hyperbolic. We've seen parabolic, I should say, has more than doubled this year, has been surging of late. I asked ChatGPT why. It said persistent supply shortages, exploding industrial demand, investor and safe haven, weaker U.S. dollar monetary expectations, and silver FOMO. Do you have silver FOMO, Peter Scheer?
Not really. It does seem like it was a poor man's gold at one point, and people who missed the gold rally bought into silver and now have been rewarded more so. So it doesn't always happen, but again, it gives me optimism for the Russell 2000 and things like that, where the stocks that have been left behind, maybe they get that opportunity to really grow.
Maybe silver's going to be the bright spot for smaller companies around the world. 3 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We have a leadership shakeup at the top at Lululemon, and shares are surging nearly 10%. The company saying that CEO Calvin McDonald will step down at the end of January after more than a year of underperformance, and no word yet on who the successor will be. But the leadership change comes as Lululemon posted solid results, even saying that the holiday season is off to an encouraging start. Meanwhile, moving on to furniture retailer RH, previously known as Restoration Hardware, its shares are rising 3.7% as it shows rare momentum in a sector hit hard by tariffs and a sluggish housing market. Third quarter revenue rose at 9%, outpacing rivals. And this is a company whose CEO, of course, has not been shy about calling out tariffs. Remember, earlier this year during an earnings call, he shouted an expletive when he saw the stock plunging due to President Trump's new tariffs. And we end over in Switzerland. UBS shares are rising 2.5% after influential Swiss lawmakers came out with the proposal watering down stricter capital requirements in a move that could spare UBS from $26 billion in capital demands that the government has been pushing. This is something that has been hanging over UBS for about a year now since they first started discussing this. So a bit of relief this morning. Lisa.
Thank you so much, Yahaira. On our radar this morning, President Donald Trump threatening land strikes in Venezuela following the seizure of an oil supertanker. The U.S. Treasury Department also sanctioning 6 vessels and 3 members of President Nicolas Maduro's family. A real sense that things are heating up in an area, and a pretty controversial move, David.
Yeah, and the specter still looming large is what's going to happen on land. And Peter Scheer, President Trump talking about this in comments yesterday, that there's still the prospect of the U.S. taking action on land. And to Lisa's very good point here, we just see things progressing down this path. I think what's indefinite or not understandable at this time is sort of where it all ends.
Not sure where it ends, but I think there is a very strict timeline on this. You don't put an aircraft carrier in that region. It's not that effective. It's very costly. There is pressure to use it or kind of lose it. So I think there's going to be a lot of pressure on Maduro. We're going to see this escalate till there's some sort of resolution. And I think it's a matter of weeks, not even months.
Yeah, which is going to be an ongoing question about how much this links into both Russia and China negotiations with the United States. We've got more on that coming up next hour. Meanwhile, China considering a package of chip sector incentives worth as much as $70 billion. People familiar with the matter telling Bloomberg the program would aim to reduce China's reliance on foreign chip makers such as NVIDIA. So here's the question. Would you prefer it to be government financed, or would you prefer it to be private sector financed? Because it seems like China's taking the public sector approach, and the U.S., David, is taking very much the private sector.
Well, this dovetails so nicely with the conversation we've been having about is this a bubble or not? Or are we seeing a lot of frothiness here? And as you've pointed out many times, I think what's key here is China's approach is so different. And so you have companies here in the U.S. doing what I think we would expect them to do, which is compete against one another in an environment where there is scarcity. Companies can't make enough of these chips, enough of these products. I think this is certainly likely to sort of make that even starker in relief.
Yeah.
Yeah, one thing we're watching very closely at Academy is there signs that China's allowing the entrepreneurial spirit to flourish again, right? If it's a government mandated thing and they tell everyone what to do, there's a decent chance it doesn't work out well. If DeepSeek wasn't a one-off, but kind of a sign that, hey, you engineers go figure things out, that's when we're in a little bit of trouble. It almost goes back to the days, right, when Alibaba rose and you had Jack Ma, and China allowed these kind of big success stories. Then they clamped down on those people and kind of made it very government controlled again. That, to me, is going to be the swing. If it's entrepreneurial, it's going to be more dangerous.
So hold on a second. This is actually a really important point. Are you saying that this is more government controlled in terms of how they're trying to support the chip sector in China? That actually is less of a threat, you think, and less potentially of an opportunity from an investment standpoint.
What tends to happen in those countries when the PRC, right, no one wants to upset the boss. So even if they make mistakes, it keeps going down, down, down before they finally realize that. So that, to me, if it's really government directed, not as dangerous. If they're giving this money and encouraging, hey, go figure it out, try and beat the U.S. and do what you want, that's when it becomes more dangerous, I think.
Which is the reason why a lot of people are looking at the chip sector very closely. Broadcom, yesterday sliding after the chip maker's sales outlook for the AI market failed to meet lofty expectations. The company's CEO warning margins are tightening while holding off on a forecast for annual AI revenue, calling the figure a moving target. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, how big of a disappointment was this, actually? I mean, they beat pretty much across the board. They came out, he said, I don't want to be pinned down. Someone tried to pin him down, and then the stocks fell. Can you give your take on this?
Yeah, look, 90 days back, they told us, they will be adding 2 new customers that are ramping up. We learned yesterday one of them is Anthropic. But the disappointing part was even Anthropic is using Google TPUs designed as the basis for their own chips. So, essentially, Broadcom's biggest customer is Google. It's almost 90% of their AI revenues. And even going forward, like Anthropic being a new customer is also using Google design. So the concentration here is immense in terms of just relying on one vendor, Google TPU designs. That is your primary customer. And OpenAI, even though they've talked about 10 gigawatts of power that they want to add, and they could be a new customer, but the timeline on that is further out. And that's where I think the market is not sure about the backlog and when it will materialize from other vendors outside of Google.
Mandeep Singh of Bloomberg Intelligence, thank you so much. I'm sure we'll be following up with you next week. Sticking with AI and the application of it, Disney inking $1 billion stake in OpenAI and licensing more than 200 of its characters to the startup. Jason Bazinet of Citi writing, we suspect Disney views the use of its IP as a free form of marketing. The use of these characters should help sustain and potentially build long-term brand value. Jason has a buy rating on shares of Disney with a $145 price target. Those shares are up 0.4% in pre-market trading. Jason joins us now. Jason, thank you so much for being with us. I thought this was a fascinating move on the part of Disney. It kind of goes to the heart of the anxiety for content creators. Is AI going to be a partner? Is it going to be a cannibal? Is it going to make you obsolete? What do you take from this approach from Disney?
Well, there's part of this deal we like, Lisa, and part that we don't. The part that we like is we'd rather see a commercial deal than litigation. And so we like the idea that they've inked something. We think Disney is going to get some cash for the use of its IP. And we like the idea that the use case has been ring-fenced. These animated characters, short-form video, that makes a ton of sense. The part I don't like is the $1 billion investment.
And explain why. I have another question, but let me tease that out of here a little bit. Why are you so down on this investment, which I think some could argue is sort of them, solidifying a stake here in a company that has had more than buzz over the last couple of years, and a lot of people are thinking is kind of the future of tech more broadly?
Well, Disney has, first of all, I've never had an investor tell me that they invest in Disney because they have an astute venture capital arm. It's just not what investors care about that are Disney shareholders. The reason I think that is Disney tends to have a propensity to invest its capital at sort of the peak of the mania. And so I could go back to, the InfoSeek investments that they made in the 90s that never went anywhere. A bunch of video game developers, when video games were growing very quickly, they shut all those down. A couple of years ago, they invested in Epic Games. I think it was $1.5 billion investment. We'll see where that goes, but that was at the height of the metaverse. And now we have the height of AI, and we see $1 billion equity investment. So, maybe this works out really well for Disney, but call me a bit skeptical.
Pour one out for InfoSeek. Haven't thought of that company in a long time. But let's get back to the use case here, Jason, because I am very curious about this. It strikes me maybe we're closer to Annmarie and John being out, and Mickey will be sitting at the table with Lisa or Steamboat Willie or Donald Duck. But I want to ask about Sora, because my sense of Sora, this product that OpenAI has made, is that it hasn't gotten a lot of widespread adoption or interest. There was that kind of flash at the beginning when my Twitter feed was just filled with these kind of insane 10-second videos that people were making, I think just to showcase or show off the technology that OpenAI had made. But I don't get the sense it has a lot of cultural currency now. And I'm curious, just sort of when you think about the way in which OpenAI is going to use this, do you have a sort of satisfactory answer from the company, a sense of sort of how much this is going to be used for PR or marketing employees, you say, or just used more generally?
Well, I don't know. It's all very much TBD. I would say that I had a number of investors ping me yesterday and say that they believe that OpenAI is sort of de-emphasizing Sora. And I would agree with you. It doesn't have a huge amount of cultural currency. I think we're still in the early days of sort of consumer adoption and embracing of all of these tools. So TBD, but I don't think it's going to be a bad thing. And, we've had a number of other companies in our coverage universe that have licensed their IP and received checks that are, on the magnitude of $50 million a year. That's a mix of sort of a fixed payment and a usage-based payment.
Jason, if I were an actor in Hollywood, would I be excited about this deal or worried about this deal?
Well, I would say that you are, I guess, excited at one level, in that there's nothing in here that sort of allows OpenAI to use the likeness of actors or actresses. But at another level, it doesn't answer the threshold question, because this is an easier deal for Disney to do because it has so many animated characters, the 200 or so that you referred to. And so I think there's still an outstanding question of how these AI tools are going to be used for the bulk of the IP that exists in Hollywood.
Jason Bazinet of Citigroup, thank you so much for this. And honestly, I ask that because this has been deeply existential for so many different content creators. How much is Netflix is going to possibly do it, but how much is OpenAI going to cannibalize from the creative process?
Just relieved personally, you're not thinking about moving to LA to be an actress.
It's okay. I think I have enough on my plate. I am curious, though, from your perspective, Peter, how much you're seeing some of these deals and tie-ups is a good thing. People trying to get ahead of any kind of innovation. And how much do you expect more of this in 2026?
As the guest pointed out, Bazinet said, it's kind of weird that there's this investment tied to it. Why is there always seems to be, we're going to use it, but there's also an investment in part of it? It seems slightly awkward to me.
Well, maybe it's something trying to get ahead of what could potentially whipsaw their shares, and they want to be a part of it. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Ukrainian President Volodymyr Zelensky floating the idea of allowing Ukrainians to vote on whether to hand the Donbas region to Russia. He says the Ukrainian people must have a say on the matter, whether in the form of an election or a referendum. Ukrainian territory is at the center of ongoing discussions as negotiators inch toward a potential agreement to end the war. Terraform Labs co-founder Do Kwon has been sentenced to 15 years in prison for fraud tied to the $40 billion collapse of the Terra USD stablecoin back in 2022. A New York judge handed down the verdict, saying the fraud was, quote, on an epic generational scale and caused significant monetary harm. The 34-year-old still faces fraud charges in his native South Korea. Apple losing an appeals court ruling in its long-running App Store fight with Epic Games. The court upholding a finding that Apple violated California law with anti-competitive conduct. The tech giant did win a chance to argue for charging developers on transactions made outside of the App Store. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, AI stretching corporate credit.
The concern around the debt loads of these companies is quite rational. The fear bubble, as reflected by the credit default swap market, may pop.
Concern versus fear bubble. Karen Mana of Federated Hermes joins us next. This is Bloomberg Surveillance. taking some of the froth out of yesterday's rally. We did see all-time highs at yesterday's close. Today, we're pulling back just a touch, led by the tech sector once again, as people do raise questions about just how high valuations are. Down 0.2% now on S&P futures, climbing lower as the session grows older. That dollar weakness turns a little bit to dollar strength, although still at 117 on the euro-dollar cross. And the 10-year yields higher by about a basis point at 4.17% rounded up, continuing to climb, even though you see the front end continue to rally. Those silver prices up 1.3%. Silver on an absolute tear to a new record high. Under surveillance this morning, AI stretching corporate credit.
The concern around the debt loads of these companies is quite rational. If you think back to the late 1990s, the concern was just a random throwing money at everything, everywhere, without revenues. We think it might actually be more the sense that the fear bubble, as reflected by the credit default swap market, may pop.
Here's the latest. Credit concerns resurfacing after a measure of Oracle's credit risk spiked to a 16-year high. Karen Manna of Federated Hermes writing, more supply next year will restore value as winners and losers emerge. Spreads may appear wider, but an increased sensitivity to valuation will be a positive for active investors. Karen joins us now. Karen, that is a beautiful way of saying that we could sell off. I mean, essentially, you're talking about the opportunities that could get created with things that go down in price and have yields go up. I mean, what kind of sell-off are you looking for?
Good morning, and thank you for having me on, Lisa. I think not described so much as a sell-off, but truly an opportunity. Spreads, which is how we measure the risk of corporate bond issuance relative to that risk-free rate or U.S. Treasury, have been historically tight, providing few opportunities for the active manager to apply our use of credit analysis and to discern value. We at Federated Hermes continue to be extraordinarily sensitive to that value. So as the broader investor community seems to look more closely at these issuances and to question, is it too much, too fast? We think that they will take that more careful look to all names that are issuing, even outside the AI industry, and just will have more opportunity as spreads are more dispersed. So not so much a sell-off as just a broader dispersion in the spreads that folks are looking for when they enter the corporate bond market.
Karen, in anticipation of that, are you holding more liquid assets to try to be able to capitalize on those opportunities?
We are. Liquidity is a very key theme for me, particularly in this market. As we enter the close of the year, Lisa, we are pretty defensively positioned as we have been. We are underweight still on corporate credit, and that is investment grade and non-investment grade. We are underweight to EM as that market has really come in quite nicely, and we've met our thesis there. Overall, we are constructive on all of these markets, including mortgage-backed securities, where we sit at a neutral position relative to the relevant benchmark. So that puts us in a position where as we close out the year and we enter into next year, that we can take advantage of the opportunities that the market might present.
That'd be awesome. It'd be nice to be able to talk about credit as something exciting again. It's been such a boring couple of years. How do you see the interplay between public credit and private credit? Is it helpful, harmful, competitive? How do you see that playing out next year?
I really think it's all of those things, and that's a wonderful way to frame that question. So with the private markets taking on the headlines, they've been in the headlines and we've heard it described as perhaps there's some cockroaches or a little bit more work to do in the market, but it has made it highly competitive. For those in the non-investment grade market, or colloquially referred to often as high yield, that has led to fewer deals in the public high yield market. So when you see less issuance and greater demand, that causes tighter spreads. So now with folks really questioning private credit, what is going on? And the true difference between that private market is in the name. You don't know what is going on deal to deal because you don't have that public market to price. You simply don't have the mechanism so that you're marking to market every day. So there's recently been shock and awe in the headlines because names and issuers in that space are talked about only in the past tense after they've been marked to zero. Well, they tend to end up in that realm. It's either priced at full or 100 or not going to pay you back. at 0. So we think that there's going to be greater discernment there, and that folks will look to the public markets as a way to invest in a more liquid part of that credit portion of the market.
That makes a lot of sense. And the one thing, we're hearing so much about the AI, the data center, the credit needs there. Where else do you see credit needs? Is there going to be a lot of issuance for electricity generation or other sectors, or is it still going to be very concentrated?
Precisely. It's going to seem initially that it is those AI hyperscalers that are issuing. But when you build out a campus, and these are exceptionally large data centers, you do need the utility support. You need all of the industrial mechanisms that come into play. So we think that we will see issuance across the realm most definitely. And that takes us to the notion of affordability, which is one that the administration and the politicians have really started to emphasize as we enter this back half of the year, which leads us into an all-important midterm election cycle. So we think that affordability for the consumer as we look at electricity will be a paramount feature as we go forward. M&A is also picking up, which is a critical part for private equity and all equity markets, but we will see that lead to more issuance in the new year. That issuance tends to be a little bit different. As we digest that in the corporate bond market, it tends to be larger in size, but often gives us a full yield curve effect where they'll issue all the way from 2s, 5s, 10s, and out the curve in order to structure the deal appropriately.
Karen, can I bring us back to the Fed meeting of earlier this week and get your thoughts on the Fed's balance sheet? We see that roll-off continue. You mentioned mortgage-backed securities just a few moments ago. We had this announcement from the Fed chair about this QE, I think we put in quotation fingers earlier in the week, and I think Jeff Rosenberg referred to it as QE confusion. How are you thinking about the role that the Fed is playing in the debt markets right now as we see it embarking on this kind of new tack, as all the while it's still trying to get rid of a lot of what it bought here in the last few years?
Yes, I think the broad theme there is that once you start to use your balance sheet to support or enhance the market, it's very, very difficult to get it precisely correct as you attempt to wind it down. And you likely are going to be in that game for an extended amount of time. So they had told us that they were stopping the balance sheet runoff, and it was a little bit earlier than anticipated, but we have seen signs of minor strain in the funding markets. So it's welcome that they are coming in to support particularly the most liquid instruments that support the very important money market industry. And they seem to be doing so in the right way and at the right size right now. So very, very important part of the Fed's work, and something that we were really looking to glean more information from the Fed's statement and from the press conference after.
Karen Manna of Federated Hermes, thank you so much for your time. Have a wonderful weekend. Peter, do you also see next year as a year of spread widening and potential opportunity or potential risk?
Yeah, I think it's going to be a really good opportunity for the credit markets. The little bit of spread widening we've had so far might continue, and you're starting to see value. Right now you can look at an Oracle and sell CDS and actually get paid if you think this is going to return. I think that's good. It's healthy. I think it's going to be a big year of issuance, and I do think we're going to see this development of what we've been calling production for security and ProSec. I had to mention at least one.
Of course, you did great.
JP Morgan's investing heavily in this. They're hiring to grow that. I think that's going to continue. I think that's going to lead to a lot. And this electricity bottleneck is going to become a big story. And the need to make our own commodities, process and refine them, I think that's going to be a huge amount of growth. And it's going to be a really interesting year for the debt markets.
Just 10 seconds. Yes or no? Are you selling protection in Oracle bonds?
I would be, yes.
All right. That's fascinating. The whole idea of a fear bubble in Oracle CDS. Peter Scheer of Academy Securities, thank you so much for being with us this morning. Coming up next, Priya Misra of JP Morgan Asset Management, Jeanette Lowe of Strategas, Liz Ann Saunders of Charles Schwab, and Yelena Shulyetyeva of the Conference Board. You're watching Bloomberg Surveillance on this Friday morning. Good morning.
The Fed is not going to solve the labor market.
This concern that the Fed has about the weakness in the labor market, I think it's a bit overdone.
The Fed is well aware of the fact that inflation remains a very sizable problem.
There's certainly a risk here that you could see inflation that's a bit more sticky.
Economic surprises keeps us in this scenario.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, with stocks poised for their third straight week of gains, climbing to all-time highs yesterday at the close as hopes for a Santa rally take hold. Investors looking beyond just big tech as they see Fed rate cuts helping to fuel broader economic strength. Now, the proof is in the pudding. A question from the economic data that we get over the next week. Of course, we get jobs data on Tuesday. We get retail sales. And then on Wednesday, we get CPI data. It is delayed. But David Gura, it is important given some of the expectations baked into market values.
Yeah, I think there's still a lot of concern about potential cracks in the labor market. We heard those remarks from the Fed chair earlier this week about the potential for there being undercounting in the jobs numbers, overcounting rather in the jobs numbers. And I think just these numbers are ones that policymakers, economists, all of us have been waiting for in this strange moment of ambiguity because of the government shutdown.
And the idea that any kind of Fed rate cutting cycle could support this broadening out is predicated on the idea that a rate cutting cycle comes with greater productivity and ongoing strength in the economy. This is a contradiction should there be either not enough strength in the economy based on some of these numbers or potentially some sort of inflationary push that we might see in the CPI.
We did have a Fed chair who seemed increasingly confident in productivity, though. He talked a lot about that during that press conference. And so we have that, the Fed story, and then, of course, the AI story percolating as well with Oracle and Broadcom. Again, the growing investor dissatisfaction with the fact that these companies can't really give a definite timetable on when we're going to see the investment in kind of what's buffeting AI manifesting itself in something tangible when it comes to actual AI.
My takeaway from this week is that people feel really good that tech is selling off because it means that potentially this is not a bubble or quite as bubblicious as it might be, and that people are using some discretion. That seems to be my takeaway from this past week.
Glad that you used the term bubblicious, but yeah, I think you're right. We're seeing the market functioning perhaps as it should or close to it.
Right now we're seeing markets just dipping after yesterday's all-time highs, led by that tech sector with that froth coming out of the system. Perhaps down 0.2% on S&P futures, climbing lower throughout the morning. A bit of dollar strength resurgence, although really it has been a story of dollar weakness throughout the week. 117 on the euro-dollar cross. 10-year yields inflecting higher more than a basis point now to 4.17%. Crude just a little bit lower, but a real question here about whether that yield curve steepening is going to be a good thing or a problem for this market. Coming up this hour, Priya Misra of JP Morgan looking ahead to 2026. Jeanette Lowe of Strategas on escalating tensions in Venezuela, and Yelena Shulyetyeva of the Conference Board on the health of the U.S. consumer. We begin this hour with stocks just really taking out some of the heat after the S&P notched a new closing high. Priya Misra of JP Morgan writing, risk assets are priced for perfection. 2026 will be a show me for the corporate sector in terms of AI-led productivity. Priya joins us now. I love having you on the show. Thank you so much for being here. So, Priya, is this kind of a moment that you're happy to see the sell-off, the skepticism in markets surrounding big tech?
So I heard you and I said, okay, that's interesting. I don't know if I would celebrate the tech sell-off, but I think it is a time when, what was this year or maybe a year and a half was about AI capex. And we've seen the investments, we've seen the valuations in these companies. It needs to broaden out. We have to find these use cases. Is that the next 6 months, 12 months, 18 months? That's a harder question. But I think over the next year or two, we're going to see the rest of the corporate sector say, here's how we're using AI. I mean, we're all investing in AI. JP Morgan's investing a lot in AI. How are we seeing that productivity? What does that mean for the labor market? I think these are all big questions. I think when we talk about the K-shaped corporate sector, the largest companies are the ones investing the most. I think we are going to now look at, okay, how is it helping your margins? Is that how you keep margins high, despite the fact that we have tariffs, for example? So I think we'll be looking a lot more at the broadening out of AI usage. I still think the growth has been fairly lopsided this year. It's been AI-led. So it's not just important for the equity market. I think it's also important for the economy if you see that productivity broaden out to just, this is all about AI capex.
You could say we're all invested in AI, including Fed Chair Jay Powell. And we'll get to that, the idea of the increase in productivity that he really indicated yesterday, or I should say on Wednesday. From a corporate credit perspective, though, are you seeing the same type of skepticism that you're seeing in equities markets when it comes to investors willing to lend to some of the AI giants for this build out?
So I think, you look at fundamentals. I think the fundamentals are still very solid. The companies, the AI-related debt issuance has happened mostly from companies that have the cash flow. That actually, if you look at leverage in those companies, it's not high. They'll very likely pay you back. But then you look at valuations and you look at how much more supply is coming next year, and you take a step back and say, okay, maybe I don't need to buy it at these tight levels. So we're not seeing the credit market en masse saying that, well, you call the debt people to the party and we're going to end the party. It's just to say, well, am I getting paid enough for that, for taking that credit risk? So I think there's some hesitation in that AI-related debt, but it's just a question of valuation. You widen out spreads in the new issue concession market, we'll be in buying. So I don't think there's some big fear. There's just a question of, you got to pay me a little bit more in terms of compensation.
How are you feeling about this moment? So we're talking about Broadcom, talking about Oracle, seeing those results. Fed chairman talking about AI more than he has in meetings past. Where are we in this story? What has this week told us about the AI story as a whole?
I think it's, they talk about the person of the year or something, the word of the year, or the acronym of the year is AI. I mean, and I think we're in that transition period where the companies have invested, some much more than others, and now we're waiting to see that use case. I think for the economy as well, there are structural positives of the economy, and I think that that's not all AI. AI is a big part of that structural positive. The other big positive is company balance sheets. The average company balance sheet looks strong. The average household balance sheet looks very strong. There's that K-shape in both corporate sector and household sector. But I think the fact that the Fed chair is talking about it, and not just productivity, what does it mean for the labor market? I think this is where, should the Fed have cut this week? Absolutely. You look at the labor data, we've never seen this rise in the unemployment rate this much without a recession, without resulting in a recession. They have to be concerned about that. And so you can be really positive on AI and still be concerned about the labor market. Why aren't new college graduates getting as many jobs as they were before? So I think we're in a period of transition, and we have to figure out all of the impacts and sort of, it's a system that has to make sense overall. I think we're in that figuring out process. I think the easy part, though, not that this year felt easy at all, but the easy part may be done. The Fed's done their normalization, their risk management approach. And now it's a bit of a show me for the labor market as well. Do companies that feel good and see the productivity, do they hire? I think that's the big question.
Is it a catalytic moment to look more broadly or invest more broadly? So again, the narrative has been, so much has been confined to these 7 stocks. So much has been confined to these hyperscalers, this particular sector. Is this the moment in which people begin to look more seriously at some of the other sectors and companies that you've been alluding to here, and Lisa pointing out in the last hour, what we've seen in small caps, what we've seen in the Russell 2000 over the last week? An indication to you that that's finally happening, that this catalytic event has happened and people are investing more broadly?
I think the investment is there. I mean, we're seeing it across the board, not just in the AI, and particularly the large cap companies are investing. Whether they're seeing the returns, I think that's where we do want to see that for us to have a lot of faith in the broadening out. But I will highlight, given valuations, it makes sense for people to say, look, AI might be absolutely transformational for the way business is done a few years from now. It can absolutely increase productivity. But who are the winners? I think given valuations, you might want to diversify who you think might end up winning. And the GPU-TPU fight is ongoing. I don't think anybody knows who the winners are going to be. So I think being diversified, I'm a fixed income person, so I'm going to talk about fixed income. Fixed income playing a role in portfolios. With equity valuations where they are, look at what bonds have done. They don't sound very exciting, but the ag is up 7% this year. Anytime there'll be this wobble, oh, we didn't see enough of that AI earnings, and there's an equity market correction, you'll see bonds work. It's happened this year. I think it's going to continue to happen. So I would say, thinking about the portfolio, your portfolio as a whole, and looking at earnings, looking at all the fundamentals, but making sure you're diversified, you have income somewhere. I think that's the role that bonds play as well. So I'm going to put a plug there for bonds.
Well, I mean, this is a plug that a lot of people are making, especially if they think that maybe people are overstating the economic growth. And if the Fed is cutting for the wrong reason, not necessarily the right reason, is that kind of where you sit, that you think that the Fed is going to have to cut a lot more, and you kind of reject the yield curve steepening in a way and think people are overestimating how much growth can really continue?
So, you can have growth, but you need not have the job growth. Remember the jobless recovery in the early 2000s? I sort of wonder about that. If you're going to get this big productivity boom, if every other company is deciding to invest in AI, do they cut back on hiring? Because of all the razor focus, sharp, everyone's looking at margins. If I don't want my margins to compress, maybe I'm going to keep hiring low. I am concerned about the labor market. I mean, we're looking at bottom-up, top-down analysis. And the one thing that doesn't make sense is why is the labor market this weak? And it could be the productivity boom that everyone's expecting. And so I don't need to hire. And so, to your question about the Fed, I think they still have a couple of cuts. Exactly. I know Chair Powell said we're in the realm of neutral. There are only 4 Fed officials who think that neutral is above 3.5, which is where we are now. So I do think they're going to cut. We see 2 states of the world. One where they cut gradually, maybe 1 this year, 1 next year, 2 next year, to try and get to that neutral if inflation starts getting closer to that 2%. And then there's the scenario where now the labor market continues to weaken and you can still have okay growth and an unemployment rate at 5%, that's concerning. That's that non-linear weakening in the labor market typically precedes a recession. Then I think you see this Fed, irrespective of the Fed chair, I think they're all unified on this point. If the labor market is clearly weak, the Fed's cutting a lot more than what's priced in or what's in the dot plot.
Which is a reason why on Tuesday it's going to be really interesting. The unemployment rate, does it rise to 4.5%, 4.6%? Because then January, very much in play. Priya Misra of JP Morgan is going to be with us for the rest of the hour. I'm so pleased to say. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. Shares of Broadcom trading lower in the pre-market after the chipmaker's sales outlook for the AI market failed to meet investors' lofty expectations. The company's CEO says it has a backlog of $73 billion in AI product orders that will be shipped over the next 6 quarters, which he described as a minimum. Sources telling us here at Bloomberg that SoftBank is studying potential acquisitions, including data center operator Switch. SoftBank has held discussions with Switch and its leadership have sought a valuation of around $50 billion, including debt, some people said. An acquisition of Switch would help SoftBank's Masayoshi Son control a key bottleneck to AI development. Rivian is unveiling its own AI chip designed to replace NVIDIA's. The automaker announcing it will equip its upcoming R2 sport utility vehicles with Rivian chips and a new LiDAR sensor. The company's CEO telling Bloomberg the move is part of a broader push to enhance automated driving features. And that is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. Up next, pressure building on Venezuela.
They've treated us badly, and I guess now we're not treating them so good. If you look at the drug traffic by sea is down 92%. And we'll start that on land, too. It's going to be starting on land pretty soon.
Jeanette Lowe of Strategas joins us as we question, is this about drugs? Is this about geopolitics? Is this about oil? A lot of questions swirling around this move. Right now, stocks lower ahead of the open. This is Bloomberg Surveillance. It has been so much of the rotation trade, and it just builds on that this morning. Yes, you're seeing the S&P lower. Yes, you're seeing futures on the NASDAQ down by 0.6% on the Russell 2000, continuing to see gains up to 0.1% in futures ahead of the open. As you do see that shift and that expectation for Fed rate cuts, 2s, 10s, and 30s, you can see that bid into the front end of the yield curve. Will key off of what we see on Tuesday from the November jobs report. Do we see the weakness potentially giving some credence to a January rate cut, 3.54%, essentially flat, a sell-off at the longer end? And a question around, does this indicate strength or does this indicate global selling off? Does this indicate an opportunity? Either way, 30-year yields back at 4.83% and 10-year yields climbing back toward that 420 mark, 417. Under surveillance this morning, pressure building on Venezuela.
They've treated us badly, and I guess now we're not treating them so good. If you look at the drug traffic by sea is down 92%. And nobody can figure out who the 8% is, because I have no idea. Anybody getting involved in that right now is not doing well. And we'll start that on land, too. It's going to be starting on land pretty soon.
Here's the latest. The U.S. upping pressure on Venezuela, as well as Nicolas Maduro. President Trump threatening land strikes on the country following the seizure of an oil supertanker off its coast. Bloomberg's Tyler Kendall joins us now. Tyler, can you give us the latest to just give us a sense of how much the tension has ratcheted up over the past couple of weeks?
Yeah. Hey, Lisa. Good morning. Well, it's ratcheted up in a really significant way. And in fact, we have new reporting out today from Bloomberg News that people familiar saying that this week marks an entire new phase of the United States strategy against Venezuela as the Treasury Department moves to sanction an additional 6 oil companies and close associates of Nicolas Maduro. People familiar are saying that this is all designed to deny Maduro oil revenue in a bid to get him to relinquish power. Now, of course, we have to keep in mind the context here. About 80% of Venezuela's export revenues come from oil. New data is showing us that the country has exported about 750,000 barrels on average per day when it comes to oil. So this is a really significant way that the U.S. is now shifting its strategy to keep pressure on Maduro. Now, of course, we saw earlier this week the seizure of this massive oil tanker. That was the first time that the U.S. had seized a foreign oil tanker since 2014. But as you mentioned, this could continue to escalate. Our analysts at Bloomberg Economics say that on the high end of the escalation scale would, of course, be some sort of land strike. The understanding is if the U.S. were to do that, it would very likely target cartel infrastructure in the country because this administration has repeatedly justified its actions by saying that this is all about going after those alleged drug traffickers and getting illicit narcotics into the U.S., trying to stem that flow. Lisa, there's a lot of different threads that we could pull on here, but I will point out one important one that we should keep our eyes on, which is that in recent days we have seen Nicolas Maduro reach out to other world leaders. Just yesterday, he held a phone call with Russian President Vladimir Putin.
Tyler, I had a quick question around the ACA subsidies. So both bills failed yesterday, and they're running out of time. I mean, December 15th is that deadline. Do you think anything can happen last minute this weekend? And if not, is it like a January, by the end of Jan, you do think that they'll come to some sort of compromise?
Well, we did hear from Senate Majority Leader John Thune yesterday after those votes had failed, saying that Republicans are willing to negotiate on something. But at this point, we only have 1 week left in the legislative session, which really means that we are careening towards the end of the year and likely will see those Affordable Care Act premium tax subsidies expire. And millions of Americans will ultimately see their payments go up. But it is important to look at the actual plan that did fail from Republicans, because that very likely could give us some clues as to where this is headed. It appears that they're going to coalesce around some sort of plan to create these health savings accounts with the idea that Americans would be encouraged to switch plans that have lower premiums but higher deductibles, the idea being that they'll have more money in their HSAs to pay for higher out-of-pocket costs. This is much more in line with what the White House would like to see when it comes to this debate. To your question on what the next deadline is, of course, we know that the government shutdown, there is a potential for another government shutdown at the end of January 30th. So that is the next date that we have our eyes on for some sort of compromise potentially to be attached.
Tyler Kendall of Bloomberg, thank you so much. Sometimes it feels like playing whack-a-mole in Washington, D.C., which raises questions about what motivations, how are they connected. Jeanette Lowe of Strategas joining us now for more. And I want to see if there is some sort of way of connecting the domestic and the international. This question of what the motivation is. How much are some of the incursions over in Venezuela due to domestic concerns about drug use, about trying to create alliances to lower prices, and how much has to do with the geopolitics of Russia and China?
Absolutely. So thank you for having me on. I think there are a lot of pieces here. The Trump administration obviously is focused on several things, and one of those is obviously focusing on America, focusing on the people of America, and the drug issue has been one of those main concerns. So I think that what we're kind of looking at in terms of all the pieces coming together right now is you have kind of the tariff risk and things of that nature that was in a big part of 2025 ending. It seems like Trump is now kind of trying to clear out the brush a little bit with regards to Ukraine, with regards to Venezuela, so that as we move into 2026, this is much more about fiscal stimulus, monetary policy, easing, you have deregulation coming, and at the same time you have potential more investment opportunities if there's an end to the Ukraine war. I do think that it's interesting that we've always had this kind of Venezuela, Ukraine piece coming at the same time. We had this when Trump was really pushing for the Ukraine deal ahead of Thanksgiving. You had seen a lot of increased pressure on Venezuela at that time. You're seeing a very similar dynamic this time. And definitely one of the things is this could be a little bit of an interplay between Russia and Venezuela with regards to Ukraine. Also, definitely there is a big piece for Trump about clearing out some of the negative influences within the Western Hemisphere. You kind of saw that as a big focus of the national security strategy that was released last week, where he really wants to focus on the Western Hemisphere and kind of making it more secure and more secure for U.S. interests. So going after drugs, going after malign influences that are within the hemisphere, and then kind of trying to shore up economic opportunities as well. I think that's a big part of this focus.
Jeanette, count me among the confused, and I'm going to posit that a lot of Americans might be as they watch all this unfold in Venezuela, and maybe look at that national security strategy you mentioned just a moment ago. Look, a lot of these drugs weren't the kind of drugs the president's been talking about. They might not even been destined for the United States. We've talked in recent weeks about the president's lack of messaging on affordability. He's dismissed that. There's kind of an impetus here for him to do more to kind of make the case for his economic policies. We've been talking over the course of the week about the fiscal benefits that can come into effect here in the new year. When it comes to foreign policy, how much is lacking in terms of this administration explaining to the American people why it's doing what it's doing? That could be in Ukraine and Europe more broadly. It could be in Venezuela. Help me understand that in the crucible of this national security strategy. Is there a coherent sense of what that strategy is right now? It does seem kind of scattershot.
I think that's something that many administrations actually have some difficulty kind of tying the pieces of foreign policy to domestic politics and giving very clear messages to the American people about what they are trying to do. And that is why you sometimes see a lot of frustration among individuals thinking about what is the administration doing and are they more focused on U.S. interests or global interests. But obviously, Trump has been focused on the border. He's been focused on the drug trade. That's obviously why you saw the fentanyl tariffs. And so I think that now he's also focused on, we're watching him kind of trying to get rid of Chinese and Russian influence within the Western Hemisphere. Now, that's not obviously going to be easy to explain to the American people, but if you can get rid of some of the cartel activities that actually can boost economic security within those countries, that means there's actually less of a migration problem. If there's less of a drug problem, that's also obviously beneficial, and that's something that he's been very focused on within his term here. So I think there's just a lot of pieces that do make it difficult. He's also trying to end, obviously, these wars to try to focus on rebuilding. Obviously, Ukraine, there's been a geopolitical risk premium in oil prices. That's obviously been another concern of his. But it's also now about creating new investment opportunities for U.S. businesses in Russia and in Ukraine. So I think that is also some of it. But there's obviously going to be this disconnect that it's always a little bit more difficult for the administration to explain to voters what is actually going on with some of their foreign policy moves.
Jeanette, really quickly, on affordability, do you expect tariff dividends or expect some sort of stimulus checks from the tariff revenues as we head into the midterms?
So what we're really focused on going into early 2026 is you had from the One Big Beautiful Bill, you had a significant amount of fiscal policy coming out, which is going to come out in the form of tax refunds. So this is kind of the SALT deduction that got increased. It's a higher child tax credit. It's the no tax on tips, no tax on overtime. So there's actually $150 billion of fiscal stimulus that's going to come out in tax refund season. So February through April. We think the administration is quite focused on the fact that is quite sizable. You also have a lot of business tax credits that are going to come out in next year. Obviously, some of companies have already taken advantage of that in the last fiscal year, but that will probably accelerate into the next fiscal year. So there's already a lot of stimulus coming. So at the moment, we don't really see the need for there to be these tariff refunds. Obviously, that can change. The affordability issue is kind of an issue there, but I think that that's something that we don't see on the horizon yet, but you have all these other tax refunds coming instead.
Jeanette Lowe of Strategas, thank you. So maybe rebates in another name. Coming up, Liz Ann Saunders of Charles Schwab on macro instability. Plus, Yahaira Anand with your morning movers. Stocks of cannabis producers moving higher as President Donald Trump pushes for reclassification. I feel like this is a very drug-heavy morning. From New York, this is Bloomberg Surveillance. The focus right now very much is on the rotation trade, and you could see that this morning in futures trading. You could see the S&P lower. You could see the NASDAQ underperforming, that big tech pushback continuing, although less than earlier this morning, down 0.5%. And then the Russell 2000 futures up 0.2% on this expectation of a broadening out. The Y can be found in 2s, 10s, and 30s. There has been this bid into the front end of the yield curve. Yes, the Fed cut rates for the third consecutive time, 175 basis points since last September. But there also is a focus focus going forward that they are opening the door to further rate cuts should the jobs number on Tuesday come in poorly enough. You can see, though, on the long end, a bit of a sell-off, a steepening throughout the curve, 4.83% on the 30-year after the auction that we saw yesterday. And if you want to be worried about the debasement of the dollar, if you want to be worried about the build-out of the infrastructure, if you want to be worried about the commodity space, take a look at silver. The hoarding continues. What you could see is a parabolic move throughout the year. The increase is more than double, 122% gains on the precious metal to a new all-time high. 2 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. A leadership shakeup over at Lululemon, sending shares surging more than nearly 9% in the pre-market. The company saying that CEO Calvin McDonald will step down at the end of January after more than a year of underperformance. And we're getting fresh comments from founder Chip Wilson, who is also one of the company's largest shareholders. He slammed the board for letting value slip under McDonald and saying that only under his pressure did the board act. So now he is calling for fresh, independent directors to lead the search for the next CEO. Meanwhile, we are seeing cannabis stocks surging in the pre-market. Take a look at Tilray. Those shares are up 28% on our reporting that President Trump is preparing to reclassify marijuana as a less dangerous drug, potentially changing it from the highest risk tier to a lower one. It's a shift that could make it easier to buy and sell cannabis. It could ease the tax burden for these companies and unlock banking services, which is one of the sector's biggest roadblocks. And we end over in Switzerland with UBS shares. We're seeing those up 1.7% after influential Swiss lawmakers proposed watering down stricter capital rules in a move that could spare UBS from $26 billion in capital demands that the government has been pushing. Lisa.
Thank you so much, Yahira. On our radar this morning, senior European officials gearing up to meet in Paris on Saturday to discuss ending the Russia-Ukraine war. The Trump administration saying it's, quote, still up in the air on whether the U.S. would attend. Meanwhile, Broadcom shares sliding in the pre-market after its sales outlook failed to meet expectations. Those shares lower by 5.9%. This despite beating earnings estimates in its fourth quarter. Investor concerns rising on how and when the company will get an AI payoff. And I do wonder, David, is this just because the shares have risen so much? Is this because expectations are so high? Is this because ultimately people are looking for an excuse to sell?
I think it might be the latter, but I go back to what we were talking about with Peter Cheer last hour, which is kind of the recalibration of expectations for these companies. So I think they have been set very high. And I should say many of these companies have met those expectations quarter after quarter after quarter. So I think it's a moment when there is just kind of a reconsideration taking place of sort of what is happening here, where it's going, and what's going to kind of be the result of it in the end.
Yeah, and how much is really predicated on the idea of credit markets remaining open? And this sort of is a real question when it comes to Fed rate cuts. How much is that going to continue to fuel some of this push into funding the AI hopes and dreams? And how much is this really going to be the cautionary tale as there is more discretion that plays out in the credit markets in 2026?
So I think the Fed's done the easy part. They've removed a large part of restriction. I'm actually watching the RMP, which is not QE, the reserve management purchases. I think that is not QE at all. They're not buying the long end. But what the Fed is doing is they're keeping the plumbing going. You know, they're letting SOFR. There was stress in that funding market. They, I think, came in earlier than most people expected to say, look, year end, tax date. These are dates when that plumbing can have an issue. And that has a very quick impact on the credit market. I think the Fed's saying, look, we're removing tail risks here. So that is positive for credit. But again, we're going to see how much supply comes in. Do earnings hold up? Does leverage pick up? So far, we're not that concerned about leverage picking up that much, but that could change next year.
I love how Jay Powell says, look, this is plumbing. This is boring. Don't pay attention. And everyone says, it's QE. Let's party. Meanwhile, the White House urging consumers to buy American made.
We want products made right here in America. Maybe you'll pay $1 or $2 more, but you will get better quality and you'll be supporting your fellow Americans by buying American.
The comments coming after President Trump once again questioned the number of dolls shoppers should buy. A new AP poll says roughly half of Americans believe it's harder than usual to afford holiday gifts this year, which ultimately, David, is going to be the question about retail sales that we get next week. How much is really inflated by prices, not necessarily ticket sales?
Yeah, and part of this broader question just about the health of the consumer, and we've had conversations about sort of what's been manifest in the retail sales figures we've gotten, the earnings results that we've gotten from retailers. We see the continued resilience of a lot of consumers, but we still see this functional K-shaped economy where there are those who are unable to play or purchase, buy homes, buy gifts to the extent they might have in years past. This dolls thing, I think, is something that's continuing to dog this administration as they struggle to kind of talk about affordability, which is such a real concern for some large swath of the population.
And it's the reason why a lot of people are looking at the midterm elections and potential stimulus that could come ahead of that, as Priya was talking about in just the last 30 minutes. Turning to markets, global stocks pushing into record territory after the Federal Reserve's latest interest rate cut. Lizanne Saunders of Charles Schwab remaining cautious into 2026, saying we believe the macro environment will continue to be unstable, but stocks can likely churn higher given a firmer earnings backdrop. Lizanne joins us now. And Lizanne, this is what a lot of people are saying. Just watch the earnings. Show me the money. And the companies can do that, and then you'll start to see gains. Just how do you think it's going to play out in terms of a tale of two halves, a tale of rotations, et cetera?
Well, we've been talking a lot and writing a lot about the K-shaped nature of this cycle. It's become a bit ubiquitous. But I think one place where you're actually already starting to see convergence is in the earnings growth rates of the tech, AI, mega cap tech, different cohorts, their earnings progress. So if you look at any of those cohorts, a year and a half ago, you were running at year-over-year earnings growth rates of about 50%, but those have been decelerating maybe into the 20% range, where the other part of the market is actually seeing accelerating rate of earnings growth. So I'm a big believer in the old adage about, better or worse can often matter more than good or bad. And I think it's the trajectory of earnings that is one of the reasons why we've seen some dislocations within these prior leadership areas, only 2 of the Mag 7 outperforming the S&P, and opportunities that are being found outside of those prior leadership names.
Lizanne, we've been paying a lot of attention to sentiment data, in part because we just haven't had the hard data as a result of this government shutdown. But you and Kevin Gordon have coined a new word here. It's the vibepression. You're warning about a vibepression. And I wonder if you kind of spell out how much of it, what it is, first of all, and then how much of a worry it is for you as we move ahead here to 2026.
I think, it used to be talked about just in the context of soft economic data versus hard economic data. So soft data would be the survey-based data, and that's where you're still showing incredibly dour outlooks. You look at Michigan's consumer sentiment kind of plumbing at cycle lows here at the same time as part of the Conference Board's index, their consumer confidence index, and they have different cohorts that represent the survey respondents. Conference Board tends to skew a little bit wealthier, but Conference Board has a question about expectations for stock prices. That's absolutely through the roof. UMich has a question about expectations for the unemployment rate. That's through the roof. That is one of the ultimate disconnects that maybe is a reference to this vibepression, or the way we used to think of it as much weaker soft data relative to hard data. You probably see a little bit of convergence in 2026, and by convergence, probably moves in both directions.
I'm curious, when you think about dispersion, where you see things kind of moving here in 2026. So if we're not going to be wagging our chins about the Magnificent Seven and the hyperscalers in 2026 to the degree which we have in 2025, where do you see that conversation moving in the year ahead?
So I think as it relates to AI, the story is certainly not in the rearview mirror, but I think there's maybe an increasing focus even beyond data centers, which was the more recent surge area relative to the hyperscalers and the original picks and shovels companies. I think the shift is more toward the adopters, the effective adopters, not just in a very general sense, but actually starting to get meat put on the bones in terms of impact on productivity, what it means for labor costs, can it help improve profit margins. So I think that may be one of the newer themes that develops within AI, is that adopter theme. But you're also seeing broader participation in other segments of the market, healthcare having some of the best breadth right now. Now, we would also caution against simplistic, monolithic sector-based investing, because there's a lot of dispersion within sectors, and that's where we think you want to apply that factor-based analysis, at least as an add-on to sector-based analysis. And the factors that we're focused on right now, to use an old school acronym, are very GARP-like. So you don't want to sacrifice growth just for value. You want to look for value, but you want to have those growth characteristics as well.
Lizanne, is bad news good news for stocks? I mean, ahead of next week, meaning if you get weak economic data, well, then the Fed's going to cut a lot more, maybe do real QE, and so equities can look through it? Or you think either the rotation trade or actually equity valuations are at risk if the unemployment rate keeps rising?
Yeah, maybe marginally bad is okay from a Fed reaction function perspective, but really bad news, especially in the labor market, regardless of what that means for the trajectory of monetary policy, I think is bad news, particularly given that the support for this economy, consumer spending resilience, that has largely been a function of not just health in the labor market, but confidence about the labor market. You start to see weaker than expected numbers to a significant degree. That feeds not just back into the consumption channels, but very quickly back into the confidence channels.
So, Lizanne, are you buying the idea of a jobless recovery? Can we see that in 2026 fueling the rotation, or is that kind of implausible given what you just said?
Well, if you look at the ADP data, all of the job growth has been concentrated recently in larger companies, companies with 500 employees or more. Anything below that is really where you're seeing the compression. You see that divide in terms of corporate profits, too. Very strong S&P profits, 13-14%, yet NIPA-based version of profits, national income and product accounts, which is millions of companies, public companies, private companies, first half of the year, and we don't have the third quarter data yet, was actually in slight negative territory. And that's being reflected in the labor market as well. So that's where I do think the bifurcations persist. I think the net is it looks just sluggish, but I think you have to fine-tooth comb it in terms of size of company in particular.
Everything is K-shaped in 2025 and possibly 2026. Lizanne Saunders of Charles Schwab, thank you so much, as always, for being with us. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Bonnie Gwynn. Bonnie.
Lisa, thank you. The U.S. Senate rejecting Democratic plans to extend the Obamacare subsidies by another 3 years. The chamber also rejecting a Republican plan to partially replace the enhanced subsidies. The failed votes raising the likelihood that premiums will double on average for nearly 22 million Americans at the end of this year. President Trump is expected to push for dramatically loosening federal restrictions on marijuana. The Washington Post is reporting an executive order would direct agencies to reclassify marijuana as a Schedule III drug, similar to some prescription painkillers. The move wouldn't legalize nor decriminalize marijuana, but it would ease barriers to research and boost the bottom lines of legal businesses. Uber says it expects to offer robo-taxi services in more than 10 markets by the end of next year. CEO Dara Khosrowshahi told us that possible new markets include Hong Kong and Japan, as it holds discussions with regulators. Earlier this year, Uber and Baidu announced plans to launch robo-taxis on the ride-sharing platform in several markets outside the US and mainland China. And that is your Bloomberg Brief, Lisa.
Thank you so much, Bonnie. I was thinking a lot about robo-taxis this morning. Have either of you ever taken
I have not.
robo-taxi?
No, I'm waiting for them.
Well, I'm waiting for them too. I'm excited for them. But who's going to clean them? I'm just thinking it could be a good job opportunity for somebody. I mean, you have to imagine.
Maybe a humanoid
robot
robot cleaner.
But, I mean, I'm just thinking, that's sort of the job opportunity that comes from AI. You think so? I don't know.
I'm waiting for self-cleaning homes too.
Oh, I think so. Self-folding clothes. Oh, yeah. I think I would love it. Up next, an uneven consumer.
The consumer has been extraordinarily engaged. It's going to vary depending on the income cohort. It's a big part of the narrative that it's not even. It never is even, frankly.
Yelena Shulyetyeva of the Conference Board joining us next as we take stock of the consumer, especially in light of some recent sentiment surveys expressing some concern. This is Bloomberg Surveillance. Inquiring minds wanted to know about the cleanliness of robo-taxis, and we got some, evidently. David Gurrow has been doing extensive research, and right now we're seeing that there is a good cleaning system, even for special incidents.
Yeah, well, you've got human oversight. They're looking at the cars, automated systems in the cars as well. And I note here, NBC News reporting a woman gave birth in a Waymo in San Francisco on the way to the hospital 2 days ago. Had the baby. Mother and kid are doing Fine.
But
it's a whole new world, Lisa.
But she might have
You've taken me down a path I didn't expect to go down on this Friday morning.
She might have had to pay an extra fee for cleaning. Right now, we're looking at a market that is churning. You're seeing that bifurcation continue, where you see the large caps do more poorly than the small caps. S&P futures lower by 0.2%. A bit of a sell-off in the bond space, particularly on the long end. The 10-year yields climbing back toward that 4.2%, 4.18% rounded up. And you do see silver climbing to an all-time high, with crude fluctuating. Under surveillance this morning, an uneven consumer.
The consumer has been extraordinarily engaged. You are still seeing the embrace of discretionary spending in addition to the necessities. So it's consumers that, again, it's going to vary depending on the income cohort. It's a big part of the narrative that it's not even. It never is even, frankly. But you have consumer spending that is still running at a healthy clip.
Here's the latest. Shoppers gearing up for what is expected to be a record-breaking holiday season, despite consumer confidence tumbling to its lowest levels going back to April. Joining us now is Yelena Shulyetyeva of the Conference Board. Yelena, could you give us some color around the retail sales data that we're going to be getting next week, as well as this holiday shopping season? Is it wonderful? Is this people looking for deals and being picky and just sort of back-ending some of their purchases to try to get the best bang for their buck?
I think so. I think the latest, earnings results are telling us that consumers are shifting towards value and essentials. And, clubs and value retailers doing great means that consumers are really concerned about what is going on in terms of prices, and they are really shifting towards those savings. So I think we are looking at a healthy holiday season, but not necessarily the best one. So I think, probably the results of the Thanksgiving holiday were a little bit overstating the health of the consumer.
Yelena, great to see you. And I'd love for you to put into context for us where we are in the capacity that companies have, their willingness to absorb costs because of these tariffs. I might posit that maybe this holiday Christmas season is kind of the last gasp for them to do this before maybe in the new year we begin to see some of that trickling down to consumers. Am I right in anticipating that might be the case? Sort of, what's the status of that, sort of their willingness to do that?
Yeah, thanks, David. Thanks for the question. I think you're right. I think holidays is probably going to be okay. But our modeling at the Conference Board shows that the bulk of the tariffs impact will be evident in the beginning of 2026. So Q1, Q2. And that is where we see the biggest softening in consumer demand, actually. So I think despite the fact that, the news cycle kind of moved away from tariffs a little bit in recent months, consumers are still feeling the burden. They're still feeling prices are elevated, and they are shifting their spending patterns. Actually, at the Conference Board, we survey consumers by different types of income. So it's the whole spectrum of income groups that we reach out to. And what I see in our consumer confidence data is a broad-based decline in income expectations. I see a broad-based decline in consumer confidence over the course of 2025. This is the time to kind of like look back at the year and assess what happened. And there was a 24-point decline in consumer confidence over the course of 2025. Consumers making more than $125,000 a year, the decline in their confidence was also sizable, something like minus 17 points.
I'm still having a hard time kind of squaring the sentiment data with the hard data, what we're seeing in terms of people, yes, out there spending money. I kind of imagine Santa Claus filling his sack with gritted teeth. He's doing it, but maybe he's not feeling good about the prices that he's paying. Is that reflective of what we're seeing here? And what do you make of that seeming disconnect between, again, the hard data and the sentiment data that you watch so closely?
I think it's the timing issue. And to a certain degree, we did see some softening in consumer spending, the actual data in September already, right? So look at the personal income and spending report for that month. Obviously, it's very stale, but that shows that, there was some softening in spending on non-durable goods, for example, right? And as things are getting more and more expensive. I think we do see that. We'll get another piece of evidence next week when retail sales data comes out. I think it's not a collapse. It's somewhat softer growth in consumer spending. But obviously, a big risk is the labor market. So what happens to the labor market going into 2026 will matter the most for the pace of consumer spending.
Yelena, good to see you. So the labor differential, which you're highlighting, I think is key here, where people feel if you have a job, you're okay because layoffs are not picking up. But do you think housing affordability is another reason why consumer sentiment is that weak? Because I'm trying to see, do the 175 basis points of rate cuts, do they help housing affordability? Like, do you think these rate cuts can actually improve consumer sentiment, or we continue to see this disconnect and sort of wait for that timing to play out?
Hi, Priya. Yeah, I think that, you're referring to the level of interest rates. And even if interest rates continue to edge lower in terms of mortgage rates, that could improve affordability. But the big part of the affordability calculation is prices. And prices are still elevated. Well, maybe they're growing at a slower pace, but they're still growing. So you have that $1 million house, and it's now $1,005,000. So it's still very unaffordable to a lot of people out there. Maybe at the margin it could help, but I think we just need continued growth in real wages going forward. As Chair Powell mentioned earlier this week, to kind of outgrow from, the economy needs to grow into that kind of state where consumers will be able to afford a little bit more and, be happy again about how they are faring.
Can't they all just be happy again? Yelena Shalyacheva of the Conference Board, you're sighing, but you're out here with Santa filling his sack with gritted teeth. Incredible poetry over here on this morning. Priya, I am curious from your perspective how much you're seeing a consumer that could surprise to the upside. I mean, do you see this idea of stimulus potentially supporting and putting something else in Santa's sack?
I struggle with stimulus. I mean, we are going to get some from the One Big Beautiful Bill. I think we have to see how much of that has already been spent. Meaning, do people expect that refund and I'm going to spend in the holiday season and then we have a hangover in the first and second month of next year? So let's see that. I see that K-shaped consumer. So if you have wealth, equities have done great, fixed income has done well, and so the balance sheet of the upper income consumer has done fine and they're able to afford things as well. It's the lower part of the K. And so a lot of this rests on, does that broaden out? The lower part of the K, does that continue to widen? And that's going to depend on the labor market. The WARN numbers have picked up. So companies are saying they're planning to lay off people. Now, if they all get absorbed, that's great, but the hiring numbers are not that good. So we're still a little cautious here.
Yeah, I think a lot of people are watching some of these numbers very closely, in particular Tuesday's labor market report. Priya Misra, thank you so much for being with us this morning. Really appreciate it. Priya Misra of JP Morgan. Coming up next, Darryl Cronk of Wells Fargo, former White House Chief Information Officer Teresa Payton, Becky Frankowitz of the Manpower Group, and Eric Cantor of Moelis & Company. From New York, this is Bloomberg Surveillance.
Mag 7 hasn't been the monolith that it had been the last couple of years.
Tech companies, healthy balance sheets, but on the margin, they're getting worse rather than better.
More cash flows generated in Mag 7 than the rest of the S&P.
There is a lot going on into next year, which is why I think we're positive, but I think there may be some volatility.
There's a 30% chance that you get a full-on bubble next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks pulling back after hitting another record high on Fed rate cutting expectations, with questions mounting about how far big tech can really go. Questions after Broadcom earnings, questions after even Oracle. Now we're going to be looking at all of the data coming out in the upcoming week, including the November jobs report, as well as, of course, retail sales and CPI. A real question here as we get some commentary from a number of the Fed members.
Yeah, a busy week for them. Opining, we heard from the Fed chairman. Now we're hearing from other members members of the committee, regional bank presidents as well, about how they see the economy, the prospects for it going forward here. You mentioned that data, a lot of it delayed. Some of these deadlines are now indefinite. Just an open question, I think, of how effective it is in telling us about the state of the economy today. Obviously, always backward looking, but now increasingly so, and I think that kind of flummoxes them a little bit more.
Yeah, we're getting commentary this morning from Austin Goolsbee, who was one of the three dissenters. He dissented to not have any kind of rate cut. He said that he felt it more prudent to wait for more information, talking about how a lot of the business people and consumers that they have spoken to in his district talk about prices, the sort of cost concerns that we think about. I remain optimistic that interest rates can come down a significant amount over the next year, as I've reiterated for months. My unease is about too heavily front-loading rate cuts and just assuming that inflation will be transitory. How much is the T word still hovering over this for FOMC?
A lot of popular fascination about Austin Goolsbee as a dissenter in that last decision. Here we see him kind of reiterating what he said all along. He is an adherent to the data. He likes to talk about the data, wants to see more data. That's been something we've heard from him over the course of the last few months, just the eagerness to have more of it. So not surprised there, but certainly interesting, again, to think about the move that he made there, advocating for a pause here until we get, I think, the big data number from next week, of course, the jobs number from the Labor Department.
On the other side, we're getting Anna Paulson, the Philadelphia Fed president, coming out and explaining why she did opt to cut rates, saying that she is still more concerned about the labor market than inflation. Next week, we get a read on that information. Next week, we get, of course, the jobs report from November on Tuesday. We also get retail sales, and then on Wednesday, CPI. So both sides of this equation, albeit with some dated measure, the idea that this should have come out already before this meeting, and yet here we are because of the government shut down. Watch this space, especially given some of what's been priced in terms of rate cuts for next year. Meanwhile, in markets, yesterday we did see all-time highs. Today, pulling back just a touch, although really as the session grows older, you can't keep a good market down. This is very much for you, Steve Chiavarone, down just now 0.1% on the S&P. Yields just slightly higher now, crossing that 418 threshold on 10-year yields. Yield curve steepening, taking hold after the Fed cut rates, and you are seeing ongoing dollar weakness throughout the week, but today marginally strength at 117 on the euro-dollar cross. Coming up this hour, Daryl Cronk of Wells Fargo as stocks trade near all-time highs. Former White House CIO Teresa Payton as Disney is officially entering the AI era. Hello, Mickey Mouse. And former House Majority Leader Eric Counter on the Fed's path ahead for interest rates. We begin this hour with stocks looking to end the week on a high note, possibly. Daryl Cronk of Wells Fargo writing, "We believe the next 12 months will favor U.S. equities. Trade, tariff, and longer-term inflation concerns could result in equity buying opportunities." Daryl joins us now. Daryl, thank you so much for being with us.
My pleasure, Lisa.
So before we get into 2026, what do you make of this week in terms of the Fed meeting, in terms of the rhetoric we're hearing this morning, and the sort of push-pull that we need more information before the Fed can more aggressively lean in any direction or give any kind of guidance?
Yeah, I think, Austin's comment this morning about significant rate cuts into next year doesn't match with how the vote came in last week, obviously. We still think, if you look at their dot plots, right, they have one cut in for next year. It's probably too light, to be candid, right? You're going to get a new Fed chair in mid-May, right, who all signs indicate is going to be dovish, right? We think there's probably at least two cuts into next year. And you're seeing that in the bond market. The bond market doesn't believe the Fed's SEP dot plots. It's saying, if you look out on Fed funds futures, that by December next year, there'll be 53 basis points reduction in Fed funds, which is two cuts, basically. I think you could build more of that in there, particularly if you see that consumer weaken, which you've talked about all morning, the labor market deterioration. I think the November jobs report next week is not going to be very pretty, right, from a headline number.
So this goes to Priya Misra's question, right? Are rate cuts a good thing if they're coming on the heels of weakness in the labor market? Are they a good thing for risk assets? How do you take that?
They have been a good thing for risk assets. We saw that reaction on Wednesday, obviously. It's interesting. I think what's changing in risk assets, if you get below the surface, is it's more of it's about cyclicals, but it's more about industrial cyclicals than it has been about consumer cyclicals. For the longest time, in the last several years, consumer discretionary has done extraordinarily well, along with tech and comm services and all that stuff. Now you're really seeing industrials take off. You're seeing financials take off. You're seeing, of course, utilities continue to take off and participate. So 2026, I think, ends up being more about kind of like an industrial cyclical play than maybe a consumer cyclical play, as the consumer still struggles with a bad labor market, poor confidence levels, and they're going to get the boost from the big tax cuts coming in the first quarter of this year. Most people don't realize that. The tax cut number is going to be up 50% year over year. It was $300 billion last year. It looks like it's going to be north of $500 billion this year. So it's material. And history tells you the consumer will spend. They spend $1.17 of every dollar they get back in a refund historically, if you go back and look at the data.
We see that disconnect between the street and the SEP, as you mentioned. I think a lot of kind of concern or curiosity about what this Fed looks like come May when Fed Chair Jerome Powell steps aside, either to become a governor, remain a governor, or do something else entirely. He wouldn't say which. We did have this news overnight, the Fed confirming 11 of the 12 regional bank presidents. There's one retirement there. But certainly, I think for those who are worried about Fed independence, a positive step forward here. How much are you thinking about that? The change in personnel at the Fed, how much is that kind of coloring your sense of where things are headed? It does seem like there's a lot of ambiguity and unknowns going into this new year when it comes to monetary policy.
Yeah, I think we think that the Fed independence, concern, risk might be a little bit overplayed, especially now that you've got the Fed regional presidents, right? So you've got the 7 governors voting. You've got the New York Fed president who always votes, and then 4 rotating regional Fed presidents, which make up the mix of how the Fed votes at every meeting that they have. So not much turnover of the 7, right? The New York Fed looks to us like it stays where it is, and you get the normal rotation of the 4, but it's going to be the same 4, right, to your point of 11 of the 12 staying home. I think had you had more of a mix-up in those regional presidents, I think you'd have restarted that whole narrative about Fed independence and influence of the administration over the Fed and that type of thing. I think everybody breathed a little bit of a sigh of relief yesterday afternoon when that news came down, minus, Regional President Bostic, who had already announced his retirement.
I'm sure you were working on your outlook for 2026 for months. It's gone through edits, et cetera, et cetera. Has anything changed as a result of what's happened this week when you look at what we've seen from Oracle and Broadcom, the kind of agita surrounding the prospects for AI, the concerns about debt? Does it change the color of or your sense of what the year ahead looks like?
No, not at all. I mean, you're going to have moments in time when you get these big transformations like AI, where things overheat and then they walk themselves back. And so to us, that looks like a short-term kind of noise. We actually launched our outlook this last week, and the title of it is called Trend Lines Over Headlines, right? And that was a theme throughout 2025, right? Think of all the noise. Go back in 25, you had DeepSeek early in the year, right? Then we moved to Liberation Day in April, right? Then as we went through the summer, the U.S. comes in and bombs 3 Iranian nuclear facilities. We walk into the fall. Like, it's the old adage, there's an axiom on Wall Street that says, if you give an investor $1 million and perfect foresight, they will find a way to go broke, right, over a year, right? Because when you looked at those news events, you would not sit here at this moment in time and say, the S&P 500 is a stone's throw away of putting the third 20% return in the books consistently or consecutively at year end here. I mean, we're up basically 17.5%. I tack a 1.5% dividend on. I'm right there, right? Which on the back of 24 and 23, that's a great return, right? Notwithstanding all that noise and headlines. The trend lines are what we want to pay attention to, and that's, monetary stimulus, fiscal stimulus, deregulation, what we think is a CapEx super cycle, and the M&A world picking back up again. All those things have real materiality to them and play through the day-to-day noisy headlines.
Which is the reason why there are so many double-digit expectations for 2026 as well, which is actually fairly rare, right? I mean, but we got from this morning, we got Goldman Sachs strategists seeing a 7,600 price target. That's on the lower end with just a 10% gain. It just kind of highlights, does it make you worried that it's so consensus now that we're going to just keep on grinding higher because of this trend line?
So people forget, if you spin the clock back to exactly this time last year, the consensus was that the U.S. economy would enter a recession in 2025. And in fact, the first quarter GDP was negative. It was down 0.5, 0.6%, right? And then we took off in the second quarter economically, right? But people were very differently positioned this time last year than they are today. Just this week, we started to see S&P 8,000 targets out there, Lisa, to your point, right? So the optimism and euphoria, we've flipped the script from last year to this year. Consensus is rarely right? Let's just call it what it is, right? History proves you over and over again that the crowded consensus often isn't the right trade as you think about what's going to happen on a forward-looking basis and not a backward-looking basis, which too many of our PhD economists and everybody else are looking in the rearview mirror all the time instead of out on through the windshield.
Daryl Cronk, I'm so happy to say that you're going to be sticking with us for the hour. While we were speaking, there was some news that just crossed. A Reuters scoop talking about NVIDIA potentially raising its H200 chip output due to demand. This was the big question earlier this week when President Trump signed off on NVIDIA's ability to sell the H200 chips to China. Would there be the demand? And really, this would suggest that the answer, which is yes.
This was just a huge open question. I mean, we can't understate that enough, have to underline that there's been this roiling debate. What should be exported to China? What shouldn't be? And there was that kind of coyness or strange moment on the earnings call with the CFO of NVIDIA where they said they're basically treating China as a zero line item on that. They weren't counting on this kind of investment. So we were all wondering, the company itself, I think, very much wondering sort of what that demand would be like. And we've certainly gotten mixed messages from China over these last few weeks. And then the news that we reported earlier this morning, there's going to be this new kind of subsidy or state focus from China on its chip industry as well. So a lot swirling around that over the course of this Friday morning.
China trying to put its thumb on the scale when it comes to its financing of domestic chips, while at the same time their companies
needing these chips from the
need the
US.
chips from the United States. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief from Vonnie Quinn. Vonnie.
Lisa, thank you. China also considering a package of chip sector incentives worth as much as $70 billion. Sources telling us here at Bloomberg the program would aim to reduce China's reliance on foreign chip makers such as NVIDIA. President Donald Trump signing an executive order to go after state-level regulation of artificial intelligence. Trump saying the industry shouldn't have to navigate a patchwork of AI rules. The order directs the Attorney General to set up an AI litigation task force to sue over state laws that are inconsistent with White House policy. Lululemon shares rallying in the pre-market on news its CEO is stepping down. The company's founder is weighing in, writing, quote, "The company needs revitalization and an infusion of new skills to get back to being a product-first company." He's calling for new independent board of directors to lead the search for a new CEO. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, the morning calls, plus former White House CIO Teresa Payton as Disney enters a whole new world of AI. Who knew that we needed a GIF with Mickey Mouse talking to you personally about your laundry? That's next. This is Bloomberg Surveillance.
There's part of this deal we like and part that we don't. The part that we like is we'd rather see a commercial deal than litigation. And so we like the idea that they've inked something. We think Disney is going to get some cash for the use of its IP. The part I don't like is the billion-dollar investments. Disney tends to have a propensity to invest its capital at sort of the peak of the mania.
That was Jason Bazinet of Citigroup on this discussion of Disney and its partnership with OpenAI. A real question about how you get involved in artificial intelligence as a content creator. Right now, big tech underperforming, but really you are seeing futures come back as the session grows older. S&P futures now barely down, less than 0.1%. You are still seeing, though, that sell-off in the yield space. 10-year yields close to that 4.18%. So a real question here heading into next week about whether we do get supportive, robust data coming out of the U.S. economy. Time now for the morning calls. First up, Bank of America raising its price target on Lululemon to $220, viewing its leadership change as an opportunity for a fresh perspective. Those shares surging almost 10% in pre-market activity. Next up, JP Morgan upgrading Citi to overweight, expecting profitability to improve next year. And finally, TD Cowen raising its price target on Broadcom to $450, highlighting upside from its business with Anthropic. Those shares still lower, 6.2% ahead of the open after earnings yesterday were fine, but then they didn't necessarily give a guide that left people with a good flavor in their mouths. Sticking with AI, Disney licensing its characters to OpenAI and taking $1 billion stake in the startup. Former White House Chief Information Officer Teresa Payton writing, "This move makes clear the Gen AI era is here to stay, and when a company like Disney loosens its grip, it shows just how quickly AI is reshaping expectations." Teresa joins us now for more. Teresa, thank you so much for being with us. Let's start there. This idea of how do content creators grapple with the AI era? What have we learned from this transaction?
Yeah, this is very interesting, bold on Disney's part, also risky, because if this AI-generated content crosses the line, both creators and consumers are not going to blame the algorithm. They're going to blame Disney. But it really is an energizing time. It'll be very interesting to see where this goes. I hope and I see sort of early signs that content creators are protected in the initial stages of this deal. So it could be that actually content creators, if it gets executed the right way, may actually come out on top. But, kind of the proof will be in the details as this rolls out.
And Teresa, we can get into whether this is the right partnership for Disney, the idea of this particular engine and exactly how people are going to be using it. But does it highlight to you something else that's taking place throughout Hollywood, throughout the creative realm, which is trying to figure out who to partner with so that you don't have to just be aggressively going after everybody? You can actually be working with them to make yourself more relevant.
Yeah, I love that you brought this up, because if I were advising Mr. Iger and Disney on this particular thing, I noticed that it's 3 years. That's too long. We don't know who the winners and losers are going to be in 3 years. And so I would have liked to see, and maybe it's in the contract details and we just aren't privy to it, I would have liked to have seen it could be up to 3 years. Maybe it's a 1 year horizon and then renewable after 1 year up to 3 years. But this does show how fast AI is reshaping all of our expectations and how urgently we need a couple of things. We need governance, we need AI ethics, we need safety standards and security standards, as well as protection of intellectual property. The creators are going to be the first to feel this the most, but businesses everywhere, consumers everywhere, you're going to see over time, we're going to have to think about what are the emerging standards as well as it relates to our intellectual property.
You opened the door with your, if I were advising Bob Iger, so I'm going to go there. And I'm very curious, when you look at the debut of Sora, it was like a mess of slop. The company got into a ton of trouble. There were the Martin Luther King Jr. videos and the like. This was really kind of something that blew up quickly, was kind of a cultural flash in the pan, and then kind of crashed cataclysmically at the end. Look, we're used to seeing Mickey Mouse play the role of Bob Cratchit with Scrooge McDuck, but when this moves into something else, you're going to need guardrails in place. And I'm just curious about your sense of the thoughtfulness that went into this deal, and both of these companies' shared capacity to deal with this, to regulate this space, and sort of how that colors the deal as you look at it.
Yeah, I mean, Disney has been a leader in sort of thinking about how to do things differently, everything from animation to movies to theme parks to resort stays. So Disney definitely does put a lot of thought and time into how they think about this. I'm assuming the Imagineers are going to be all over this. But you bring up something really important, which is sort of this shared responsibility the two companies now have to the governance and guardrails. And I don't know that any company right now really understands the combination they're going to need to have for moderation of these different things that are posted on these online platforms. So it's going to have to be somewhat of a human-led, human precision around the content that's generated and making sure it doesn't violate the terms and conditions. We're not going to be able to leave the job up to AI to govern AI, because I think in the end, AI will decide, meh, it's probably okay. So I think you're right. There's a shared responsibility here. We need to underscore that. And hopefully they're going to have people all over this as far as those governance and guardrails, looking at content and being very assertive around taking down content that could damage the brand, be bad for public safety, and some of the other things that are sort of unintended negative consequences.
I'm going to sound like a huge skeptic here, but put this question under the what are we doing broader question. And that is, you have at the enterprise level, companies wondering about how AI is going to change the way they work, pouring a lot of money into this, maybe not knowing exactly what it's going to be like when it's put into effect. Here we have Disney doing this, and I'm just kind of curious how you react to the question of, like, is this it? I mean, is this kind of the radical change that AI is going to bring about, that like Lisa's going to be able to make a delightful 10-second video with Mickey Mouse or Donald Duck? What does it say just about our sense of where this technology is going versus sort of what we kind of recognize as we're able to do right now?
It's a great question. And, this is an example of, sort of that keep your friends close and your frenemies closer. I'm not sure how Disney is looking at all of the different AI content platforms, but we know they had a beef with Google that is under discussion. And now they placed a bet on OpenAI. So I think what we're seeing here is some early bets being placed. I don't know necessarily that this will be an ongoing sustaining relationship. We'll just have to to see. But it is smart on Disney's part to lead the way, to say, well, we're going to place a bet on this. We're going to learn from this. We're going to pilot this type of partnership and relationship. I think, again, 3 years is too long. That's just my humble opinion here. But I think it's smart for them to place a bet. Hopefully, again, the Imagineers and the governance and guardrails that Disney can bring to bear and the discipline that Disney can bring to bear is going to result in something smart. I do think this will start a new wave of announcements like this. So I do expect to see other entertainment groups as well as other companies announcing big partnerships like this.
Former White House Chief Information Officer Teresa Payton, thank you so much for being with us. Daryl Cronk still with us here from Wells Fargo. From your perspective, is this a good deal?
I think it's actually a better deal than initially people thought, right? It's the classic boardroom / management strategy of partner and police at the same time. Partner with OpenAI, figure out where you're going to put, to Teresa's good points, the guardrail, and then police, what they considered to be kind of intellectual property theft or illicit use that didn't have guardrails and was not codified in some way, right? So this allows them to say, look, we have a partnership with OpenAI. It's short form video. We have this cast of 200 characters, right? So it puts those tight guardrails on what that universe looks like, and then that way they can defend it in the corporate universe where people are using it in long form video or in other places, TV, where there's no rules to the road type of thing.
We were talking about, is this a good thing or a bad thing for Hollywood actors, for scriptwriters? Yeah. And there is this issue of what is the precedent here after the strike that we saw last year in terms of AI-generated content? Do we have a clear sense of that, or does this just raise more questions than answers?
I think it's the latter. It's more questions than answers. I think the actors and actresses will really question where's that line of demarcation between, can you use my voiceover? Can you replicate it through AI? Do I have any, contractual rights there? Am I getting paid for that and monetized in any way? So I think all that still has to be figured out. But you've got to take the first step of the partnership. And Disney had to establish the partnership. I completely agree with Teresa that this is going to unleash a fury of kind of other partnerships and considerations. Obviously, we see that already with what's happening with, the Netflix, Warner Brothers, Skydance, saga, right? So the media world is really becoming kind of ground zero for a lot of those battles about what the future looks like and who's going to control it.
Yeah, which is to your point, are we going to be here or is it going to be Donald Duck sitting here? And the question of what the labor market will look like and how it gets affected.
You'll see.
Tune in Monday. You never know. Coming up next, we'll talk about the labor market. Becky Frankowitz of Manpower Group on the impact of AI with respect to jobs. From New York, this is Bloomberg Surveillance. I should listen to Steve Chiavarone more often. Yesterday, futures were lower, and he said by the end of today, it's going to be higher. Well, right now, we're seeing futures that were substantially lower, and as the session grows older, less so. S&P futures down by 0.1%. You are seeing a little bit of reprisal for the dollar, although just. We've seen dollar weakening, 117 on the euro-dollar cross, and yields now crossing that 4.18% level on the 10-year, as you do see that yield curve steepening. Turning to the Federal Reserve, as we hear from multiple speakers today. Bloomberg's Michael McKee joins us now. We did hear some comments from Austin Goolsbee. Just curious about the reason behind some of these dissents.
Well, that's what we're getting, the explanations. It's become a tradition lately for Fed officials to explain as soon as the blackout lifts why they dissented, and the blackout has lifted. So we got a few minutes ago Austin Goolsbee's comments from the Chicago Fed saying basically people are telling him inflation worries them more than jobs. Goolsbee said almost all business people and consumers that we have spoken to in the district lately identify prices as the main concern. I remain optimistic that interest rates can come down a significant amount over the next year. As I have reiterated for months, my unease is about too heavily front-loading rate cuts and just assuming that inflation will be transitory. Now, just now we are getting breaking explanation from Jeffrey Schmidt from the Kansas City Fed, who also voted to hold rates steady. I continue to hear concerns about inflation, My conversations suggest we are at risk of moving away from a situation where, to quote former Chairman Alan Greenspan, inflation is so low and stable over time that it does not materially enter into the decisions of households and firms. So those are the dissenters, and we will be hearing from other Fed officials. We heard from Anna Paulson, who was not a voter this time. She's the new Philly Fed president, but she is going to be a voter next year. She says that labor market is more of a concern to her. But somebody else who has focused more on inflation, Beth Hammack of Cleveland, is also speaking in a little while, and we expect her to sound much more like Goolsbee and Schmidt. Makes it harder for anybody coming into the Fed to try to convince people to cut interest rates a lot, to have all these dissents. And we had another effort last night, or another move last night, that also would make it harder for the president to get his way. The Fed has now confirmed, reconfirmed all 11 of the 12 Fed regional presidents. This happens every 5 years. Bostic from Atlanta has announced his retirement. That's why only 11 of the 12. Renewals would kind of foreclose a path to Fed control for Trump, because unless the Supreme Court says he can fire people at will, then he's not going to have a chance to replace Fed bank presidents either.
Michael McKee, thank you so much for breaking that all down. Daryl Cronk of Wells Fargo is still with us. And Daryl, I'm curious your perspective. Which do you think is the bigger concern, inflation or the labor market?
I actually think the labor market is a bigger concern. I mean, so stay with me on the timeline here. If you go back a couple years, in 23, non-farm payrolls average for the entire calendar year, 220,000 a month, right? 24, 186,000. Year to date, 25, at least of the data we have, 151,000. I think 26 non-farm payrolls probably average somewhere between 30 and 50,000 new jobs a month, right? Which is a material shift down, right? Yes, you're not seeing, you're getting this low hire or low fire environment that everybody talks about. But I think the growth of the labor market is really hitting a stall speed kind of point. Inflation to us looks like it's hanging out here kind of in the upper twos, right? It's not coming down to the Fed's target zone, and there's going to be kind of corresponding pressures. It's interesting because, I do think you're starting to see the early signs of AI having that disinflationary push, right? Which is important, because when you start throwing all that stuff in the mix, right, about what's happened with price increases and immigration and tariffs, and that all should be inflationary, you have to ask the question, why is inflation not moving higher than it is?
Well, that's exactly what we want to stick on, this question of, are we seeing disinflation because people aren't getting hired? And this is what Howard Marks of Oak Tree Capital Management was warning about with the impacts of AI. Take a listen.
I'm not talking about investing or economics. I'm talking about society. And it's very worrying to me. If we can find a way to replace their income, I worry about purposelessness. And, we get so much from our jobs other than a paycheck. And you can't replace that stuff. So I worry for society.
Becky Frankowitz of staffing firm Manpower Group writing, AI is reshaping work, but not erasing it. Blue-collar demand remains stronger than white-collar, though this appears to be caution amid the evolving AI landscape rather than a long-term trend. Becky joins us now, and Becky, I'm so grateful that we get to speak with you, because there is this real anxiety. You heard it there from Howard Marks. Will AI cannibalize from the labor market and leave people out of work? What's the early evidence showing?
Yeah, good morning, Lisa. We're seeing a labor market that I would say is definitely cooling. So I would agree with the gentleman from Wells Fargo. It is cooling, not collapsing. There are still pockets of growth in industries and jobs. And this widespread impact of AI that we read in the headlines is not yet realized, but we are seeing early signs.
So what are the early signs? Is it just idea of blue collar taking over for white collar? Is it the idea that companies are more reluctant to hire? Is it that productivity comes on the heels of smaller workforces?
Yeah, it's all of that, Lisa, and more. So let me give you the data. As we look at real-time data, I think you asked me 4 or 5 months ago the percent of job mentions that require AI. It was about 2% at the time. That held steady until the last 3 months. It's now 5% of mentions. And you might say, well, that's not that big. That big of move in 3 months in our economy is quite large in terms of in-demand AI jobs. The second impact I would note, again, an early sign, software developers have been the number 2 job in most demand in our country since 2023. This year, it drops number 3. When you think about that echelon of job demand, to see that drop also significant. And the final piece of evidence, I would say, is early indication is when we see the demand for college graduates start to decline. And so the number of jobs, the percent of jobs that do not require a college degree, entry-level jobs, has jumped 36% in the last year.
I hear the sobering comments from Howard Marks about what this means for society, and it does give me pause, especially when I think about the way that the Fed chair talked about AI and productivity during the course of the press conference following the meeting this week. He's willing to engage with it, but still I think acknowledges the fact that there is so much that we don't know about the effect this is going to have on the labor market. We've talked a lot about timing in the sense of when is the construction of data centers going to lead to advances in AI and what's that going to mean for work? How about when it comes to productivity? When you think about where we are and having a more holistic understanding of the impact this is going to have on the labor market, where are we? How much are we fumbling here with no real sense of what it's going to mean in real terms?
Yeah, so first, David, let me say I loved Howard's responses. I believe in work. It's the whole purpose of Manpower Group. We believe in meaningful and sustainable work. Work produces good societies. It produces good families. So I'm so grateful to hear someone from the capital market start talking about that. In terms of productivity, again, we are seeing the anticipation of AI. So if you ask me to step back and say, what are employers actually doing? Are they seeing the business cases? Not yet. They are stalling hiring in anticipation of what AI can do. I spend a lot of my time with CEOs and CHROs, heads of HR of companies around the world. In fact, I was with about 12 of them in the last week. And what I hear from them is the promise of productivity, but not yet the realization. But there's active work in almost every major company that I speak to understand the process changes that can be implemented to drive productivity. We're just not realizing that yet. It's anticipatory stall, not real reality stall.
Hey, Becky, great comments this morning. I'm curious, when we look at the labor market, much is made about the softness, the deterioration of the labor market. Where we do seem to see strength, at least from our standpoint, is in tech hiring, healthcare hiring, and maybe a little bit of hospitality. Are there other areas where you're seeing, so if we think about the whole labor market maybe sliding this way, but there's pockets of strength, where should people be thinking about those pockets of strength?
Yeah, so nice summary, by the way. Wells Fargo's well informed. I would say first, we're seeing for sure in healthcare, but there's a bit of nuance now in healthcare. Registered nurses, not a new topic. The new growth we're seeing, physical therapists, radiologists, there's some new pockets of growth in healthcare. Retail has been quite a surprise. Of course, we expect seasonal hiring. We have gotten that. It continues. But we're seeing frontline workers, cashiers, stockers, those are in demand. And in tech, you mentioned tech. You heard me speak to the software developer decline, but there are new jobs in tech that are up triple digits, almost 300% increase on a low base. Data scientists, people who know how to use machine learning. So we're seeing these pockets of growth, but I'll give you a surprise one. In times of transition, management is crucial. We are seeing growth in executive leadership demand. So the demand for managers and leaders who can help us transition through this time we're facing in the labor market. So those would be a couple of the pockets of growth that we're seeing.
Just quickly, Becky, how much are you starting to see entry-level work start to pick up as well? Because that's been a big concern.
Yeah, so I'm very concerned about college grads because we are seeing decline in the need for a degree in terms of demand. Entry-level work, it depends on the industry, Lisa. We're definitely seeing in food service, 8 of the top 10 hirers in our country today are food service or retail. So there are definitely on-ramps for those industries, and they are not requiring college degrees.
Becky Frankowitz of Manpower Group, thank you so much for being with us and for that gut check. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. NVIDIA shares rising in the pre-market amid reports that the chip giant is ramping up production of its H200 AI chips. Reuters is reporting that consideration comes from strong demand from Chinese clients after the sale of the chips was signed off upon by officials in both the US and China. Orders for the chips from China have exceeded NVIDIA's current output level, requiring the company to increase capacity. Uber is saying it expects to offer robo-taxi services in more than 10 markets by the end of next year. CEO Dara Khosrowshahi is telling Bloomberg News possible new markets include Hong Kong and Japan. Earlier this year, Uber and Baidu announced plans to launch robo taxis on the ride-sharing platform in several markets outside the US and mainland China. The Education Department has added a, quote, earnings indicator to the free application for federal student aid. That will indicate any school where the average earnings of its graduates fall behind average earnings of high school graduates. Around 23% of colleges in the federal database classify as low earnings. And that is your Bloomberg Brief. Lisa.
Vonnie, thank you so much. And thank you for everything this morning. Daryl Cronk of Wells Fargo, thank you so much for being with us this morning. Always wonderful to get your thoughts.
Thank you.
Have a wonderful weekend. Up next, setting you up for the day ahead, plus former House Majority Leader Eric Cantor on the Fed's path ahead for interest rates. This is Bloomberg Surveillance.
There's still questions surrounding, the big tech, the AI story, but you're seeing the equal weight S&P 500 do better, Russell 2000. I think it's helpful that the Fed is buying some T-bills up to $40 billion a month. So you're seeing all that. There's a lot more questions around the AI data center, but if rates are coming down, I think we're going to get rate cuts faster than market's pricing. That should be really good for small caps and the broad economy.
That was Peter Shear of Academy Securities. As small caps continue to outperform, it's what we're seeing this morning. You are seeing the broader indices lower ahead of the open, down just about 0.1% on the S&P. You are seeing that bond sell-off continue on the long end, even though that front end has been pegged 4.18%. And you do see silver surging to new all-time highs, less than an hour away from the cash open. Here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. Broadcom's results had all the makings of a strong quarter with an earnings beat and a dividend boost, yet shares are falling more than 5.5% in the pre-market after its $73 billion AI backlog for the next 18 months fell short of the most bullish expectations on the street. CEO Hock Tan tried to soothe investors, calling it the minimum, yet it was not enough. Meanwhile, with social media driving this mindset that you can't wear the same thing twice because of photos, people are flocking to rent the runway. Shares are surging 25% after the company handily beat earnings estimates and said that it is sticking to its guidance for double-digit subscriber growth this year. And we end on Lululemon. Shares are rising more than 10.5% now in the pre-market. The company saying its CEO Calvin McDonald will step down at the end of January after more than a year of underperformance. And we heard from Chip Wilson, the founder, in the last hour, who's one of the company's biggest shareholders. He slammed the board for letting value slip under McDonald, and now he wants the CEO search to be led by fresh, independent directors. Lisa.
Thank you so much, Yahaira, and have a wonderful weekend. Meanwhile, stocks just hovering near those all-time highs heading into the opening bell as investors set their sights on growth possibilities in 2026. Former House Majority Leader Eric Cantor joins us now, currently of Moelis. And I want to start on the economy and all of these deals that we see going on. I mean, is this just an incredibly robust deals pipeline on the heels of a benign economy and wide open capital markets?
Yeah, Lisa, I think you're right. I mean, I know at Moelis, our bankers are really busy as we come into the very end of the year running through the tape. And so there's a lot of dialogue. We're in the business of advising on transactions. Transactions are a tool for companies to accelerate growth, to figure out how to better position, to gain efficiencies. And as you say, there are accommodative capital markets right now, too. And so we are seeing just a lot of dialogue, a lot of activity, and I think a general optimism as we come to the new year.
What's interesting is in markets right now, you're seeing a bit of skepticism, pushback. Broadcom, perfect example of that. We also saw that with Oracle. Debt investors are saying you need to pay up a little bit more. As vice chair of Moelis, are you seeing that pushback in any way, shape, or form? Or are deals just coming out of the woodwork in ways that keep even your associates really busy?
Well, I think if you look at the strategic sort of universe, I mean, they are and have always had a list of where they're heading in terms of targets and the kind of deals they want to do. And certainly in the sponsor world, there are other sort of forces at work, the need to recycle capital, assets that may need to go into a continuation fund. I mean, there are all types of different tools available for clients, investors, sponsors, strategics. And as you say, I think overall, the framework and the environment is more constructive now. Certainly Washington, when people look to the regulatory impact, we have sort of come out from under this very, very negative regulatory outlook that we had in the prior administration.
Talk a bit more about that. So when you're talking to executives about that regulatory environment, how would you describe it? I mean, we see some of these agencies where there's not a full panoply of commissioners, for instance. We heard it from the Treasury Secretary. Maybe there's going to be some new corporate tax policies coming here into effect in the coming weeks. How much of it is still inchoate or clear for you at this point, of where it's headed regulatorily?
You know, I think with this president and this administration, I think there is just sort of an acceptance that you're never really going to know for certain anything because of the way that, you know, the rapidity that things are about in Washington, the way that President Trump sort of approaches, you know, the power he's got and the position. Very unique. But I think on the whole, it's a much more constructive regulatory environment. And you just don't have this overhang that you had in the prior Biden administration where, you know, there was really an anti-business sentiment. And if you just remember, it's like eons ago, but with the likes of Lena Khan and Jonathan Kanter, they were sitting in these spots in the head of the antitrust regulators, and they really definitionally said, if you are bigger, that is bad, and therefore we're not really inclined to allow you to do it. Whereas this administration, it's not like it was under the Bush administration, but it's certainly much more constructive and they like to do deals.
As you've watched that parade of executives going through the Oval Office, some of whom are giving up equity stakes to the U.S. government, what are you thinking as a lifelong Republican, this kind of new breed of Trump Republicanism that involves, again, it's not dirigism, but it's sort of like the state is having a heavier hand in the way that these companies are being run.
David, I still remain a limited government, free market Republican and conservative. So it's obviously something very new to me to see that the government wants to take a stake in a business and or a toll if it's an export. That is something that is obviously, and I think for the majority of the members that are in the Congress now, it is something that's very new. But I do think it's much more in keeping with what President Trump is about and what his career's been about. It's all about deal making. And I think if you look at sort of the Intel situation and what happened there, it was more of a response to the disdain that the White House had for the CHIPS Act and just giving away monies and instead say, hey, we need to do something for the taxpayers. Now, where I have an issue is the governance rights. That is, it's not as if the federal government has not stepped in before. I mean, you and I were down there when the great financial crisis happened and a lot of bailouts. You look at the airline industry, you look at the GSEs. I mean, there's a lot of history, but the difference, before, there was always sort of a path and a known path to an exit. That's right. And now not so clear.
Well, this is sort of the concern, is that right now, if you're putting an emphasis on deal-making, deregulation, and potentially jawboning the Fed to cut rates more aggressively at a time that the economy is still chugging along, at what point are you setting up the risk of that kind of scenario once again in 2027 or 2028?
Well, listen, I think this president has been very consistent in his message of growth, and he wants growth, and that is the way, and that is where sort of the more traditional sort of conservative Republican can come along with the agenda, because we've always been about real growth comes from the private sector. And if you look at where the administration has been taking stakes, it's really in these industries that are critical to the national security. It is about AI related. It is about the rare earths minerals. It is all about how do we go and continue to take the lead in these critical sectors vis-a-vis China and other bad actors.
How do you think this administration has done with respect to messaging around affordability? This is something that has been dogging the administration quite a bit. Now we're talking about dolls and Christmas presents, but there's this issue of people aren't feeling great, even though the economy is chugging around. What do you think? What do you think the Congress should be doing? How do you think the president should be messaging this?
Well, it's interesting. After the off-year elections, one of which was in my state of Virginia, and the party didn't fare well, the president was fairly nimble, and 10 days later turning around and taking the steps he did in lifting the tariffs on 200 food items, and which directly impact people when they go into the grocery store to look to prepare for the holiday meals, including not just the things that we don't grow here, but like beef, right? And Brazilian beef. And there's a real inflationary pressure in the beef industry in this country, and I think the administration took the steps necessary to provide the relief. So I think you're going to see a lot more accommodation in terms of that as we head into the new year. And look, the president's also, this is something also very novel, David, back to your original point about the kinds of things this administration's doing. He's talking about a dividend from the tariffs. I mean, but that is something directly related to the issue, Lisa, that you bring up, and that is, how is a president supposed to bring down prices when we're in a free market?
Don't have a whole lot of time left, but I want to ask you about the prospect of the fiscal stimulus in the new year from the tax bill. I mean, the president talks about so much. Maybe he hasn't been focused enough sort of on the potential benefits of that for ordinary Americans. How do you see that playing out in the year ahead?
Look, what's going on with AI and with CapEx necessary to bring about this infrastructure, not just in the data center piece and all that, but on the power end of things. I mean, there is a tremendous tailwind we're going to experience from the ability to completely, write off the expense up front. So I do think, and I think most economists will say, there will be an uptick in terms of what that will do to increase people's willingness to go and put capital to work.
Vice Chair Eric Cantor of Moelis and Company, also the former House Majority Leader. Thank you so much for being with us this morning.
Happy holidays.
Have a wonderful weekend and happy holidays. Coming up on Monday, Cameron Dawson of New Edge Wealth, Sarah Hunt of Alpine Saxon Woods, Russ Kosterick of BlackRock, and Keith Lerner of Truist. A real focus on the data, David, next week.
Yes, looking ahead to those jobs data, I think highly anticipated. We'll see sort of how that changes our read of what happened at the Fed meeting this week.
Exactly. Is good news good news? Is bad news good news? How are we going to message a Fed rate cut that might come on the heels of some softness in the labor market? Right now, what you are seeing in markets is just a touch of softness after reaching all-time highs. Again, you can't keep a good market down. Look at that. We're almost to positive territory, and we are seeing yields climb on the long end, 4.18%. That does it for us. Have a wonderful weekend. This was Bloomberg Surveillance.